it all comes down to the labor market.
The markets have definitely moved from worries around inflation to worries around labor.
The labor market can turn very quickly, which is why I think Fed officials have to be cautious as they watch these data.
A strong report's probably not going to prevent them from cutting, but obviously a weak one could.
I just feel like the risks on the employment side are increasing to the point that you want to put more weight on that.
This is Bloomberg Surveillance with Jonathan Fargo, Lisa Abramowitz, and Anne-Marie Hordern.
It is Payrolls Friday, live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. We are coming into Friday, heading towards a third week of losses, and the sell-off deepens. It spreads through Asia, into Europe, and back into the United States. Equity futures, your scores look like this Friday morning. We're down by more than 1 full percentage point on the S&P 500. On the Nasdaq 100, down by 1.8%. The winner of July, the loser of August. The Russell down by 1.9%. The focus is on one thing, payrolls. The difference between the Fed having more time and running out of it. The guess this morning looks a little something like this. 175K is the estimate. That's the estimate for headline payrolls. For unemployment, it's going to be a big focus for us later this morning. We're expecting that to stick at 4.1%. We'll catch up with Juckes a little bit later. The question he asked at his note over at SocGen this morning is the last 24 hours, Anne-Marie, a canary in the coal mine or a red herring?
Well, Mohamed Al-Arian this morning, taking to Twitter, said it took a while, but it's now happening in a notable manner. Markets are realizing that the slowing of the U.S. economy is faster and broader than many had initially thought. The question I woke up to, Jonathan, is this a now paradigm shift in the sense that is U.S. exceptionalism starting to wane? Is U.S. exceptionalism now over?
We can get to the earnings in just a moment. I want to talk about the data of the last 24 hours before we go into payrolls. U.S. manufacturing, the ISM, contracted the most in 8 months. You look at the employment component, the worst since June 2020. In addition to that, we had the highest print on jobless claims going back to August last year. Danny, we're all trying to figure out the same thing. You've been covering this with Manistru this morning. Is this another head fake or is this the real deal?
And the thing that we're going to need to see to discern that is whether the jobs weakness we're seeing is just, still sort of this market where supply is really plentiful, immigrants are coming into the country, and that's why you're seeing some of the data, or are we seeing real layoffs? And I think that's going to be the key. That's going to be the difference when we really get worried about labor. Is the unemployment number moving up because you have companies like Intel letting go of 15,000 employees because they're facing issues now?
Check out the names in the pre-market. They're getting hammered right now. Danny mentioned Intel. Intel delivering a total dog of a quarter. Apple reporting weakness in China. Amazon's forecast disappointing. Intel's down 21%. Danny, we can sit here and say it's idiosyncratic, but I have to say I've sat here many a morning over the last few weeks and talked about things being idiosyncratic. Idiosyncratic adds up. Those job losses add up.
This is the important thing, because it's not just Intel. Again, you could say that about, McDonald's didn't do a saver menu quick enough. Delta has been mispricing their seats. The important thing is that these are missteps and they're being punished because missteps matter more when you have a weakening economy. And I think that's the distinction. Idiosyncrasies matter now because you can't just kind of paper over it because demand is strong enough to fix for those things. So the point is that these companies are making missteps. And missteps are a problem now.
And now it's hurting investors. Intel has been paying out a dividend since 1992, and now they're not going to. But I'm glad you mentioned McDonald's. This is something else Mohamed Al-Arian has been talking about for years. Don't look at basically all the hard data that's coming out. Listen to what CEOs are saying on the earnings call. What did McDonald's say this week? Is that consumers are coming in and they are discriminating against higher prices. You're seeing the pushback when it comes to consumers. You're seeing higher credit card delinquencies and all that pandemic savings, that's dried up.
We've seen that repeatedly, not just in McDonald's. We've seen that repeatedly over the last few weeks this earnings season. Let's get to the scores more broadly. We look a little something like this. If you're just joining us, welcome to the programme. Equity futures negative by more than 1%. The rally on 10-year treasuries continues into a 7th consecutive session. We're down by 4 basis points on 10s, a break of 4% in the last 24 hours. Your yield, 393.76. Coming up this hour, we'll catch up with Verrone, Strategas, with treasuries rallying going into the jobs report. Bloomberg's Mandeep Singh joined us on Amazon's disappointing outlook. And Juckes of SocGen saying US markets have been priced for policy perfection. We begin with our top story. Treasuries rallying going into the jobs report, with traders boosting bets for Fed rate cuts following weak economic data. Verrone, Strategas, a Baird company, writing the following. The question that is coming up on client calls is to what extent do lower yields suggest the bond market sees something it doesn't like? Chris, you join us now for more. Chris, good morning, sir.
Great to be here.
I want to give you some credit. This is the rally you've been on top of for quite a while. You were looking for this break lower in bond yields. Are there good reasons for it?
Yeah, listen, I think if you go back really all year, what's been the pattern on the chart? It's been lower highs in yields and lower lows. I mean, we peaked all the way back at 5% last October, almost a year ago, and every single successive rally in bond yields since then has failed at a lower high. I thought it was very notable what maybe 10, 15 days ago, we broke below that 425 level on 10s. It was a huge level, and we broke below 465 on 2s. Those were the kind of key technical dams that gave way over the last couple of weeks. But at the end of the day, the question that we're attempting to answer is, what does the bond market know here? Is it simply anticipatory of easier policy, or is it suggestive that there's some meaningful growth issue? And we'll use, I think, the equity market to help answer that question.
What do you look to?
Yeah, it's like, are we seeing the big weakness in financials? Are we seeing that? Yesterday notwithstanding, I know everything got sold yesterday, but I think it's a little early to jump to the conclusion that the bond market is dead set on some imminent recession here. And I would also just add that credit conditions have largely been pretty benign here. I know there's been some widening over the last couple of days, but you're not seeing just the complete blow up in credit that you typically would see ahead of a major problem.
Do commodities confirm or deny?
I think it depends where you look. I mean, gold's broken out to new highs this morning, roughly. I think they like lower real yields or lower nominal yields. Crude, as we know, has been weak. So at some point, you also have to start to wonder, when do lower yields and lower crude actually recatalyze some of the growth story? So there's that may be to come in the back half of the year here. Copper has certainly been weak to the extent that reflects China. But the commodity picture is very, very mixed here. I think the strongest trend, without question, remains gold.
Still, even with bonds, it's remarkable that they're still rallying this morning, because you could say we've moved from 4.7 in your 10 to under 4. We have something like 150 basis points of cuts priced in the next 12 months. We've completely obliterated that higher for longer narrative. Is this not an asymmetric risk going into this earnings report that everyone has coalesced around this really bearish story?
Yeah, I think what you've seen in the positioning is a massive shift over the last few weeks when people got caught off sides. And you can see that in the price action. You see it, I think, in the follow-through over the last several days. John and I were saying off air, what happens if you get a soft number and you actually put your low in bond yields today for the next couple months? I don't think that's out of the question. Yields are very oversold here. 375 on 10s, I think, is probably a good interim low. I think under 375 that's when you begin to say, okay, what does the bond market really know about the economy that I haven't quite figured out yet? So that would kind of be my line in the sand, particularly the 2-year yields. They are very, very oversold here. So I wouldn't be shocked, irrespective of what the payrolls is, if we actually got a bounce in yields over the next 4, 6, 8 weeks. I think that ultimately would fail at a lower high. I think you still want to be kind of secularly more bullish bonds here, but we'll see what the next couple weeks bring.
I'm just trying to understand what the reaction to equities would be to that, because we do seem, again, I know you say it's only a few days, but it does seem like a shift. That bad news is bad news, and we have a growth scare. Well, your yields go lower, and so does the price of equity markets. What tells you that holds or not?
I mean, we have 80% of stocks above the 200-day moving average. I wouldn't say this is a market that's been dying internally for the last 6, 8, 10, 12 weeks. If anything, it's actually been improving over the last 6, 8 weeks. That's not where your big problems generally come from. We're into a weaker seasonal. We're into an election season. Could you get consolidation, correction? Absolutely. History tells us those tend to be modest. History tells us those tend to be modest, particularly when you enter that period in a relatively strong trend. I think we're going to change the sentiment really fast here. Whatever kind of residual bullishness was out there, I think will decay pretty quickly. So I would be careful getting too worked up about this just yet.
Not just the weakening U.S. economy, but there's also been a flight to safety because of geopolitical concerns, also falling U.S. government bond issuance. How do you discern why the market is moving?
Yeah, something we've always said in our work is you have to kind of really differentiate between what you think should happen and what will happen. And I know all year there's been all this anxiety and angst about a couple bad auctions, about this untenable debt situation that we're on. The market doesn't care right now. Right? Those may all be things that matter at some date in the future. The market doesn't care about them.
Are you trolling Lisa
here
while she's on vacation? Is that what you're doing?
I am trolling Lisa.
We're throwing shade at
Brahmo. Listen, I think gold has had this figured out all year, right? Gold has been the decider between what could happen and what should happen. What should happen? Should the Fed be cutting into a relatively strong economy all year? Probably not, but I think gold knew that they probably would. And gold strength has likely reflected that.
You mentioned the election. Cutting through the noise, what policies are you looking at that are going to impact the bond market in 2025? And how do you even remotely start to plan for that?
Well, I think a couple weeks ago when we were last on and we were talking about the likelihood of a Trump presidency, or what maybe seemed more likely then, would it result in kind of 2 feet off the accelerator, particularly on the fiscal side? And is that right? Maybe a month ago we were on talking about what were bond yields starting to pick up? And I think they were starting to pick up that maybe you get much less fiscal impulse in 25. And I think certainly that's been on display here. I am curious to watch how, what were described as the, quote, Trump trades over the last, 6, 7, 8 weeks, financials in particular, maybe small caps to an extent, how they behave here over the next 4, 5, 6 weeks. Because there's certainly been, I think, an attitude shift towards the left in terms of a better chance of winning this election. Does the equity market actually continue to reflect that over the next 6, 8 weeks? I'm reluctant to believe any election signal in August. I think it's going to be a noisy month. Let's talk Labor Day and kind of see how these things are starting to shake out.
You were drawing a distinction between what will happen, what should happen. I want to talk about what is happening outside of the United States. Dollar yen is absolutely ripped lower.
Yeah.
We've gone from talking about the 160s to the 140s. The Nikkei 225 in the last 2 days, 2 sessions, we're down more than 8%. Yeah. We've had people come on this programme repeatedly and say the Japanese equity trade is not about what's happening with the currency. We'll not be upset by what happens over at the BOJ, and then what happens? It's falling apart. Yeah. What do you make of the moves we've seen over the last few weeks?
My favourite part about this business is picking up little clues and then putting together some call around it. And the little clue that we began to get in April, May, June, all the Japanese exporters started to meaningfully underperform. And if yen was going to 170, that should not have happened, right? So you were seeing stocks like Toyota really weak, and we were sitting here, okay, some part of this market knows something. And this market knows yen's about to strengthen. What does that mean? We're very oversold in the short term on dollar yen, kind of in the high 140s, 150 range. Could you bounce from here? Yes. I think a bounce would fail at 153 to 155. I think you're talking about meaningfully stronger yen in the future. It's the exact opposite of what we saw in 2012 when all these Japanese exporters actually began to outperform in anticipation of a weaker yen. So there's a lot of clues coming from the equity market of where yen is heading. Now, what are the implications of that? Well, sell yen, buy tech has been the global carry for as long as many of us have been doing this. And I wonder if the kind of tech trade is reflecting that here.
Interesting. You think these two stories are connected?
Absolutely. And
is this a train you want to step in front of?
Absolutely not. I think the change in yen has tentacles far beyond what it means just for Japanese stocks or what it means just for dollar-yen cross. I think there's a really important kind of pushback against this global carry.
Given what you've just said, then, you couldn't sound more bearish, because basically you just told us that we're going to get meaningful appreciation in the Japanese yen through the rest of this year. That makes it very difficult to be constructive on the rest of the market, doesn't it?
I think we're starting a process where path of least resistance for yen is stronger, not weaker. And that's a change from, obviously, where we've been for a decade. I do think in the very short term, a lot of this stuff, the rubber band's been pulled too far. 155 on dollar yen would be good resistance. I think, something like maybe 420 to 430 on 10s would be good resistance if you rallied them here. But we've started to change some really big trends.
Super smart. Chris, it's good to see you.
Thank you. Good to be here.
Thank you, sir. Thank you, and great call on the bond market over the last few months. Chris Verrone there of Strategas, a bad company. Equity futures this morning negative across the board. On the S&P 500, we are lower by more than 1 full percentage point. Let's take the opportunity to get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. U.S. President Joe Biden telling Israel's Prime Minister Benjamin Netanyahu it's time to agree to a ceasefire with Hamas. In a call on Thursday, Biden pledged to support Israel against Iran and Hezbollah. But the president said he was, quote, very direct with Netanyahu, saying they have the basis for a ceasefire and Netanyahu should move on it now. Venezuela opposition leader Maria Corina Machado calling for nationwide protests to defend what her party sees as its rightful electoral victory. This coming as U.S. Secretary of State Antony Blinken says the U.S. backs a transition of power. In an address to the nation, President Nicolas Maduro warned that 2 maximum security prisons would soon be ready for the thousands of Venezuelans who have protested the election results. And a joint sports streaming venture between Disney, Fox, and Warner Brothers Discovery now has a name and a price. Venue will launch in the fall and cost $42.99 per month. The platform will provide live access to major leagues, including the NFL and NBA, while including content from both ESPN and TNT. Venue will compete with ESPN Plus, which costs $10.99 a month, and the Hulu Plus Live TV package, which costs $76.99 a month. Smaller competitor Fubo filed an antitrust lawsuit back in February against the companies due to the tie-up. That's your Bloomberg Brief. John?
Yahara, thank you. I cannot spend any more money on sport. I'm right here.
Well,
the limit.
Pretty sure you have Hulu, right? And this is going to be direct competition to Hulu, so you might be covered.
Hulu, Peacock, Paramount for the Italian football.
Whoever's naming this stuff. Venue?
Come on.
What is that?
Come on. I'm done. Up next, threading the AI needle.
If you end up actually with too little capacity, then you have service disruptions. That means companies can't scale their applications. However, if you actually deliver too much capacity, the economics are pretty woeful and you don't like the returns of the operating income.
Disappointing outlook from a couple of these big tech titans. That conversation up next, live from New York City this morning on this Payrolls Friday. Good morning. Michael Hartner, Bank of America, called it classic risk-off. Hard landing risks are clearly rising at a time when consensus holds a soft landing or no landing view. South stocks, that dropping a little bit early this morning. We'll talk about that a little bit later. Equity futures, if you are just joining us going into payrolls, the sell-off continues. We're down by more than 1 full percentage point on the S&P, negative. In the bond market, the rally continues. Yields down by 4 basis points. The 10-year, a break of 4% in the last 24 hours. We're down to 393 on a US 10-year yield. Under surveillance this morning, threading the AI needle.
If you end up actually with too little capacity, then you have service disruptions, which really nobody does because it means companies can't scale their applications. So most companies deliver more capacity than they need. However, if you actually deliver too much capacity, the economics are pretty woeful and you don't like the returns of the operating income. While we're investing a significant amount in the AI space and in infrastructure, we would like to have more capacity than we already have today.
So here's the latest. Amazon falling in the pre-market. The company's outlook for operating income falling short of estimates, telling investors that profit will take a backseat to AI spending in the near term. Meanwhile, weak sales in China overshadowing a generally upbeat report for Apple, the iPhone maker expecting its new AI features to drive device upgrades in the coming months. To break it all down for us is Mandeep Singh of Bloomberg Intelligence. Mandeep, let's start with an absolute dog of a quarter for Intel. Intel just looks absolutely awful. The stock, and we don't use this word often, but I think we can say it, the stock's essentially crashing in the pre-market and early trading. Mandeep, what is going wrong at that company?
I mean, clearly they're losing their share on the data center side. And there's a reason why NVIDIA is doing so well, is because not only is it getting all the incremental CapEx spend, it's actually taking share from the likes of Intel. So that's one. The other is Intel has been investing on its foundry business for the last 3 years. And there's nothing to show over there. No revenue and, not even a ramp in terms of what they're doing on the foundry side. And that's what spooked investor because that's impacting their gross margins. I mean, now we are talking about sub 30% gross margins for Intel, which was unimaginable 5 years back. And I think that's what's going wrong with them.
Mandeep, 50% of its workforce it's letting go. Where are these jobs that they are laying off from?
I mean, look, it's across the board. I think they realize on the chip side, they don't have much exposure in terms of GPUs. So clearly there are cost cuts on that front. And the foundry business is where I think they need to make a decision whether to divest it, whether to keep it. And if, they won't keep getting a pass because they were the recipients of, all the subsidies that the government is giving, and that hasn't helped them either. And I think the time is running out when it comes to showing execution on the foundry side.
To be fair, Intel is by far having one of the worst reactions to an earnings, but it's not just them in the chip-making world. It's ARM, it's Qualcomm falling 16% and 15% after their earnings. This is a really cyclical market, Mandeep, But can we tell where we even are in a chip market, in a chip cycle, when you have distortions coming from both COVID and now AI?
I mean, this quarter is all about AI, and that's where, you are finding out who the real AI winners are. Clearly, that's NVIDIA. AMD, everyone thinks they are getting there, but they are so far behind when it comes to showing the growth around AI relative to NVIDIA. And Qualcomm and others are the same. They don't have as much exposure as NVIDIA does, and that's where the market is really separating, who the real winners are versus who benefit, but just a tad bit.
Mandeep, bear with me. I'm just going to go through NVIDIA over the last 3 days. Yesterday, down almost 7%. Wednesday, up 13%. Bear in mind, Wednesday was the biggest addition in market cap on a single stock in a single day in the history of US markets. The day before that, we were down 7%. That is some real volatility on one of the biggest companies on the planet. Mandeep, what is going on with that name?
Well, look, I think everyone realizes they're going to have a great quarter. And in fact, the next 2 quarters are going to look great because the market is still undersupplied. But the stock market will look ahead, 12 months from now, 18 months from now, what kind of quarter NVIDIA will have. And that's where, there is volatility. Will this growth continue or will it taper slightly? But there is no doubt NVIDIA is the real winner when it comes to this AI wave. Every company has increased their CapEx this quarter, barring Apple. And that just goes to show that, from the hyperscalers themselves, they're going to see 35 to 40% growth for the next 6 months.
Mandeep, could we talk about China for a moment? Just broadly, how concerned are you about what is going on in potential slowdown in China based off what we saw from Apple as well, the fact that their iPhone market is still hitting some bumps?
Look, I think there's no doubt long-term that Apple business in China, it's going to taper, it's going to decelerate, no matter how they try to, maneuver it in terms of ASPs versus making sure the Chinese government is still on their side. But longer term, it's going to go down. And Apple has done well in terms of making sure they smooth out that transition as opposed to doing it in a knee-jerk way. And credit to them, the services business grew 14%. That's what sort of insulates that steep decline in EPS or margins that everyone was hoping we don't see with Apple.
And can I just ask, what happened to their VR headsets? It literally wasn't in the earnings anywhere, and they made such a deal over it.
Well, look, if you're not talking about AI this quarter, there's something wrong with you as a tech company. And clearly, I think they're realizing they need to make that pivot. Look at Meta. I mean, how well they had the best quality beat and raise this quarter, partly because the whole call was about infusing AI into their apps and actually benefiting from it. I think Apple has realized they need to focus more on AI, although still they are very disciplined when it comes to the CapEx side and how much they spend on AI. But clearly, the narrative is shifting, and it will shift more in the upcoming quarters.
Mandeep, Anne-Marie mentioned China. Do you think a strong currency is a good excuse for the weakness we saw?
Yeah, I mean, FX does have an impact, but, it shifts from quarter to quarter. So I wouldn't make much out of it. In the end, it will come down to AI. That's the story. That's what everyone is focused on. And I think that's where you will see the mega caps really separate, the ones that keep growing top line and margins. Like Microsoft beat, 30% revenue growth for an $80 billion run rate business. It's so impressive.
Yeah.
And I think that's where you will see the separation.
Mandeep, thank you, sir. Appreciate the update. A lot to cover. Mandeep Singh there of Bloomberg Intelligence. Particularly on Apple, looking ahead to September and this upgrade cycle we've been talking about now for months and months. In fact, I would say for years. A lot of people think this step up is going to be that significant in the next 12 months that a lot of people will ultimately upgrade.
I just wonder if we're really contending with how weak the consumer is and whether they're actually willing to upgrade if it's expensive, even if it has AI.
John's my litmus test for this. He doesn't like upgrades on the iPhones, but will he upgrade for that artificial intelligence tools?
I'll let you know later this year. Kit Juckes of SocGen joins us next on a jobs report 2 hours away. Equities look like this on the S&P 500, negative here by a little more than 1%. Some negative follow through from yesterday. We're down by 1.6% on the Nasdaq 100. The underperformance is where the outperformance has been. The Russell, the small caps, down by 2 full percentage points. Is this the real deal? Danny, we've had a few head fakes over the last 12 months. Jobless claims are back to where they were last August, and we played this game last summer as well. Is this a welcome cooling or an unwelcome deterioration in this labour market?
Again, I go back to the idea that it's all going to matter if this is layoffs, if that's what's forcing this move higher in unemployment, that you have these companies that are letting go of their workforce because they're realizing that just cutting costs is not going to save their margins, that they need to let people go in force. And that's when you get that nonlinear move. And that's when you say, okay, maybe 50 basis points is on the table.
The volatility in this equity market has been unreal. We closed out July with the best day of gains since February. And then we took it all back the following day as we kicked off the month of August. Switch up the board and get to the bond market. Let's sit on a 10-year yield. 7 consecutive days this 10-year has been rallying. Yields are dropping again by 4 basis points. Over this period, we've seen a drop of more than 30 basis points. Danny, that's quite a move in the last week or so.
You take it back to April, we went from 4.7% to under 4%. You have multiple cuts priced in. You have 150 basis points of cuts over the next 12 months. How much more juice is there really left in this rally? I mean, is the risk not asymmetric? I asked this to Chris Verrone. Because you have this narrative building that things are really bad right now, that the jobs data is going to be horrible. 175, what we're expecting, is still fine. That is not the world falling apart. So did we overdo this bond market rally?
What's the danger zone here? What is like a really bad print? What is the bad news story later on this morning?
The thing I worry about, and Managed Cranny has been really good on this, that there's just going to be a lot of confirmation bias in these numbers. That regardless of what we get, people have decided that things are really bad, that even a slight tick lower than what we expected will be enough to continue this bond market going as it is.
There's a feeling that for a lot of people, if we get strength, we'll ignore it, that it's not real. If we get weakness, to your point, it will just confirm previous. Let's turn to the foreign exchange market. I want to sit on this. Dollar yen, the move we've seen on dollar yen from the 160s down to the 140s. We have broken below 150 in the last couple of days, 148.84. We're down another third of 1% on that currency pair. A 5th week that dollar yen has moved lower. That is the longest weekly streak of the year so far. This week, I think we're down another 3 percentage points. But it's the move of the Nikkei 225 that gets your attention as well. As this Japanese yen strengthens, this stock market is getting absolutely hammered. The Japanese equity market, Danny, down by almost 6%. We're down 8 in a couple of sessions.
And I think you've put this so well that so many people have said, look what's happening with Japanese corporates. There is a fundamental shift happening. They're getting more investor friendly. Warren Buffett is in this market. You want to be investing, and it doesn't matter what the macro is. The truth is that it does matter. You can see it in the price action over the past week that a strengthening in the yen is a problem, not to mention just the technicals of it. Japan is a much more liquid market than the rest of Asia. So if you're looking on a day like today where your entire portfolio is getting beaten down, Japan's a really easy place to sell. And I think a lot of people have overlooked the technical factors of this market.
Brutal moves. The consensus calls of the last, 6 months or so, getting unwound in a pretty vicious way over the last month or so. Under surveillance this morning, a top story for you. Shares of Amazon falling in the pre-market after warning profits will take a back seat to AI spending in the near term. Meanwhile, Apple seeing poor sales in China overshadow a generally upbeat earnings report. Nvidia is the last of the Mag 7 to report later on this month. Politico reporting the DOJ is investigating the company's acquisition of Run AI, Anne-Marie, on antitrust grounds.
And this was actually, it seems like a pretty small acquisition in terms of NVIDIA, I think $700 million. What it feels like is like potentially you have the DOJ starting to look at these AI leaders because they don't want them to become the social media or e-commerce behemoths that we already have in the United States. So they're getting in ahead of it and potentially some concerns they have. Also, shaping a lot of this when it comes to safety, national security concerns. So I think you're going to start to see a lot more of these crackdowns coming from Washington when it comes to these AI players.
We're seeing this massive spend on AI. And Mandeep Singh of Bloomberg Intelligence was with us about 10 minutes or so ago. And what did he say? NVIDIA wins, Intel loses. That's the story of this quarter.
Well, the great thing for NVIDIA is that all of the hyperscalers we've heard of, despite the market not liking what they've heard, they've all talked about this huge spend they're going to do this year. I think Amazon yesterday was something like over $60 billion for the year. If you look at where NVIDIA gets its revenue from, it is Meta, it is Amazon, it is Microsoft. Microsoft is 20% of its revenue. So you could say, yeah, the market really didn't like these earnings, but these companies are spending, and ultimately, who does that benefit? It's NVIDIA.
That's the earnings story. Let's just take a beat and pause. Just fantastic scenes on American soil in the last 12 hours or so. President Biden and Vice President Kamala Harris welcoming home Wall Street Journal reporter Evan Gershkovich and other Americans freed in the largest prisoner swap with Russia since the Cold War. The swap including 16 people going to the West and 8 returning to Russia. Just beautiful scenes on this side of the world.
Absolutely amazing. And our photographer that was there on the ground actually has this pretty incredible photo of Evan Gershkovich lifting up his mother, just pure joy. And you can actually listen to the conversation President Biden had with all their families around them, phoning into the airplane as they were in Turkey, coming over to the United States. Really incredible moment. Obviously, though, I think in the next few weeks, after people start to recalibrate, what does this actually mean? The U.S. got back civilians and they traded for assassins and criminals, basically.
This was a prisoner that was swapped in Germany that the German government did not want to give up. Someone who assassinated someone in broad daylight just for, again, normal journalists. I have to say the Wall Street Journal has such a good piece on this. It's something they've been working for years, essentially, since Evan was first jailed. It ends with saying there's basically this pro forma form that you need to send to Putin when you're being released to say, you know, please release me. People usually don't really fill it out. He filled it out, and at the end of it, asked for an interview.
I can't wait to read his book. And I hope it includes a sit-down with Putin somewhere not in Russia, maybe when he goes on one of these overseas trips.
Yeah, I'm not sure he'd want to do that again. Just unbelievable. Fantastic scenes here in America in the last day or so. Let's turn to the economic data. The US jobs report just under 2 hours away. The median estimate in our survey looking for a print of 175k. Kit Juckes of SocGen warning the jobs data have more potential to move markets than usual, writing this. The US manufacturing sector has been losing momentum and employment growth has been slowing for months. The question is whether we are near a tipping point where the pace of slowdown picks up enough to make the Fed wish it had started to cut rates sooner than it has. Kit joins us now for more. Kit, it's great to catch up with you, sir. I just read the first line, if you note, as soon as it dropped earlier this morning. Canary in the coal mine or a red herring? Kit, which one is it?
We won't know till September or October. We're at that time of the year where if you think, you know, new people leave school, they look for jobs, companies look ahead at next year and make their plans. And if they feel nervous about next year, they hire fewer people or they lay people off because they don't need them, start making those kind of announcements. When people come back from vacation, they decide whether they're being really cautious with money or whether they fancy going out and spending more. And, you know, it always feels to me, it's one of the reasons August is a fascinating month and a terrifying month, illiquid and a great guide to where we're going next. I think we'll know more by then. So far, you've got to say the unemployment rate is super low. The employment rate is super high. The economy is not weak. It's just losing a bit of momentum. To the earlier question, I think we need to look at the private payrolls number because we should ignore what's happening a little bit on the public sector. That was just under 140,000 last month, 136,000. That comes in under 100. I think there'll be some fireworks in markets this afternoon. That's probably the place to watch. But this has been an extraordinary cycle. It feels tired to me, but hey, I'd have said the same thing last year. You know, it's been so resilient. So. I'll watch the numbers for this month and next month. Yeah. And then we'll know.
Kit, does it feel tired because we're tired of it? Or are you looking at the economic data and it signals that this cycle is ultimately tired? Because we've had growth scares like this before. We've had head fakes, particularly in jobless claims. Had one last summer. What's the difference between, say, last August when jobless claims were at these levels and what we're seeing right now?
I think there's certainly less spare post-COVID money floating around for a large hunk of the American population. There's less external drivers of strength. There's nothing that sits there and says it's going to make things accelerate. Other parts of the world are more clearly slowing. So there's a lack of things you can put your finger on that says, yeah, this could be okay. And I think that's probably the single biggest piece. But I'm with you. It said this mad cycle has, you know, you would never have guessed we'd have got this far from 2020 without having had a proper recession. I mean, it's just like, how did we manage to keep this plane in the air, in the sky for so long? Yeah, it'd be nice if it keeps on happening. I think it gets tougher each mini cycle to do that.
And Kit, that is what has had people thinking that there's going to be a recession for over the past year plus. But this has been a really good year to fade all of those impulses, to fade six cuts priced in at the start of the year, and then on the other side, to fade no cuts priced in. At the moment, for the next meeting for September, 33 basis points of cuts are priced in, which does imply that we have about even odds for a 50 basis point cut, when we just heard from Powell on Wednesday, who was cool, calm, and collected. Are we not getting ahead of ourselves?
Yes, in a sense, we always are. In other words, do I think we're ahead of ourselves on rate cuts? Something dramatic has to happen for us to get a 50 basis point cut next month. And I mean dramatic. At the moment, this is an economy that's, I don't know what it's doing. It's driving along at 55 miles an hour. It's doing perfectly all right. You just worry about it, that it's unlikely to be able to accelerate. It's more likely to slow down. But fading recessions is always the right call until the day they start to happen. I think we'll learn a lot this summer. I'll be fascinated to see if this number comes out, because what we do know is that when momentum slows, it slows quite quickly in most cycles. But right now, if you looked at the state of the U.S. economy, all you can say is inflation's coming under control, the Fed's going to cut rates, and the economy is not weak. It's just trundling along just fine and better than anybody would have thought 18 months ago.
Kit, when you say dramatic, what would that mean in today's payrolls report? What's a dramatic number?
Sub 100 on private sector payrolls. So they were 136 last time. So that puts it in context. If you come in with a number at 120 on overall payrolls, I mean, I think I'm going to try to phase out the public sector employment piece just to keep on going. But you get under 100 on the private sector, you start saying, okay, that's more of a problem. But it has to be something at least like that. Otherwise, this is summer noise and we might just overreact to it because we're in August.
Okay, I just want to jump back to dollar yen just quickly. I think we always want that fat directional move in the FX market, and we had it one way on dollar yen, and we're looking to add to it going the other way. Is this move exhausted? How do you sort of gauge how far this one's gone and whether it's running out of steam?
Yeah, if the Fed gets rates most of the way back to where they were before we started in 2020, we'll get back to 100. But you cannot go at this speed because it's the rate of change, it's the change in the value of a currency that affects inflation and affects businesses. So this is hurting the equity market because it's having a really aggressive impact on profitability and on what people do. So we have to pause. We have to pause, perhaps bounce. We can't keep on going at this pace for much longer. If the Fed's cutting, I don't think we can be above 140 next year. If they're cutting a long way because there's a serious slowdown, then yeah, we can go back to 120 and see where we go from there. So there's a long way to go for, but this is very much a function of where U.S. interest rates are, right? This was possibly the biggest carry trade that we've ever seen because the Japanese kept still while the Fed hiked and hiked and hiked and hiked, and everybody else did in the rest of the world. And now if everybody else goes all the way back, we will go a long way. But the appreciation hurts profits, cuts inflation, and so the rate of change is massively important. We need to pause. I'm not sure if we can pause much in the middle of August, for what it's worth.
We'll see what happens over the next month. Kit, appreciate it, sir. Kit Juckes there of SocGen. We have to pause again, and we have to pause to read through one quote from one op-ed from one Wall Street giant in the Washington Post this morning. Jamie Dimon of JPMorgan. Now, people often say, why do we always talk about Jamie Dimon and the prospect of Jamie Dimon going into government? Well, Jamie Dimon himself sort of encouraging that conversation this morning. Check out this quote. The private sector has huge wells of expertise and produces 85% of our nation's jobs. It should have a seat at the table. Yet in recent years, government leaders have often failed to engage those in industry. And Maria President should put the most talented people, including those from business and the opposite party, into their cabinet.
This is the most blatant ask to be a part of administration I think I've really ever seen. What is so interesting as well is it's almost like Professor Jamie Dimon. He's talking about the U.S. as an inflection point. He's going back in history. But he keeps saying the next U.S. president, the next U.S. president. Well, whose team are you on? Is it the next U.S. president, Donald Trump, or the next U.S. president, Kamala Harris? What remains to be seen, we don't know who he's pushing for, but what's obvious is that he wants a seat at the table, regardless of who's in the White House.
Well, I wonder if some of the points he's making exclude him from one ticket, because he talks about the need to support our allies, to have diplomacy, trade, and the active promotion of democratic values. I don't know, that seems like one administration would not necessarily want to go that way.
It's quite a column, and I suggest everyone will have a read of that here on Wall Street throughout this morning, including JPMorgan employees. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. Chevron missing second quarter earnings expectations, putting renewed pressure on CEO Mike Wirth as he pursues a $53 billion takeover of Hess. The takeover was agreed to nearly 10 months ago, but has been delayed by an arbitration case brought by arch rival Exxon, which claims to have right of first refusal over Hess's stake in a Guyanese oil development. Chevron also saying it will relocate its headquarters from San Ramon, California to Houston, Texas, with full migration of operations completed over the next 5 years. Chevron shares are falling down more than 2% in the pre-market. Meanwhile, Intel shares are plunging in the pre-market after the chipmaker forecast revenue for the third quarter that missed analyst estimates, along with making a string of disappointing announcements. The company said it would suspend its dividends starting in the fourth quarter, and it will begin slashing 15,000 jobs. And Andy Murray ended his tennis career with a quarterfinals defeat in men's doubles at the Olympics. The multiple Grand Slammer jokingly posted on X that he, quote, never even liked tennis anyway. Murray had said this summer's Olympic Games would be his last event. Over the course of his career, Murray won 2 Olympic gold medals, one in London's 2012 Games and the other in Rio de Janeiro in 2016. He won the U.S. Open once and Wimbledon twice, his first win at the All England Club, making him the first British man to win that trophy in 77 years. What a run. That's your Bloomberg Brief. John?
Yahara, thank you. I'm not sure what it is about this Olympics and making me cry. What is it about?
Same.
Last couple of days.
I credit Simone Biles and I credit Andy Murray too. Not him necessarily losing, but the reception he got afterwards. Everyone gave him a standing ovation. The Americans were clapping for him. It's just really tugging on the heartstrings.
Super emotional. A lot of people cried about the opening ceremony too, but for very different reasons. It's a very different kind of crying. Up next on the programme, all eyes on the labour market.
The labor market is not necessarily on the precipice of breaking. We've seen non-farm payrolls, yes, with increased volatility, but an average pace of over 200,000 thus far for 2024. That's still indicative of a relatively solid labor market.
That conversation up next, live from New York. You're watching Bloomberg TV. Payrolls 1 hour and about 41 minutes away. The number we're looking for, the estimate on the headline print, 175. That's the estimate in our survey. Going into it, the scores look like this. We're down another 1 percentage point on the S&P 500. Bonds are still rallying. Yields are lower by 3 or 4 basis points. We rallied for a 7th consecutive session. The 10-year, 393.95. Under surveillance this morning, all eyes on the labour market.
The labor market is not necessarily on the precipice of breaking. We have seen a loss of momentum. We've seen non-farm payrolls, yes, with increased volatility, but an average pace of over 200,000 thus far for 2024. That's still indicative of a relatively solid labor market.
So here's the latest, counting down to the July jobs report due at 8:30 Eastern. The median estimate in our survey calling for 175K. Sarah House of Wells Fargo has this to say. We've revised down our call for payrolls to 165. Our previous call was 180. We're incorporating the jobs market data of the last few days. Sarah joins us now for more. Sarah, that's a good place to start, the data of the last few days. What was it about that that was a little bit jarring for you, jarring enough to bring down your forecast?
Yeah, it was really a confluence of the data this week. So it started with the last of the Fed services PMIs, which showed that on average, you saw hiring in the service sector, the index declined about 2.5 points. We saw downward trend in job openings, but really the gross hiring rate back to 2014. You look through later in the week, upward drift in jobless claims, and I really think the cherry on top was that ISM manufacturing and employment print, which I think together points to that the trend in hiring really has downshifted over the past month.
Sarah, what number today, if any, could mean the Fed will cut 50 basis points?
Yeah, so I think it would have to be pretty low. I think certainly below 100,000, maybe even closer to negative. I think it's also going to be important in terms of what was driving that. So to what extent do we see some potential effects from Hurricane Beryl hitting during the survey week? And so I think we'll have to try and strip out part of that. But I think it would take a pretty weak number to at least get the Fed to move 50 basis points at its next meeting, given that you still have some hawks that I think are concerned about the overall inflation backdrop still, and making sure that they don't want to ease up too soon, and they're okay with a little pain in the labor market.
But for those that are the doves, you get this sense that they worry that the Fed's behind the curve and they'll need to cut a lot in order to catch up with where the labor market is going. Michael Hartnett of Bank of America hits on this, that people underestimate how much lower rates need to go to stimulate a weak economy. Sarah, if some 500 basis points of hikes on the way up didn't act that quickly to bring inflation in, what's to say what's needed on the downside to make sure this labor market doesn't deteriorate further?
Well, I think that the Fed will, they do have a lot of ammunition, I think to stimulate the economy. And in many ways, there were so many unique circumstances around this pandemic that I think kept growth strong and made it take a while for inflation to come down. So, of course, the supply shortages impacting inflation, but also as they recovered, helping the growth picture as well. But I think as we get back to a more normal environment, that you could see the impact of rate cuts, I think maybe taking on a more traditional role. But I think ultimately the Fed needs to get going soon, just given that we have seen, I think, some market deterioration in the jobs market the past year.
If the Fed needs to get going soon, you think we've already seen the market deterioration. Do you think they've already made a mistake?
So I think it's still a little bit too early to tell, but I think, again, given that you have seen some pretty unique circumstances, and it is hard to parse out just how much of the slowdown over the past year has been this idea of normalization versus outright deterioration. So I think right now it's still more a matter of normalization, but given that negative momentum that we continue to see in the jobs market, something has to change to arrest that, and I think that change is a policy change here soon.
Sarah, I just got a message from a Bloomberg Terminal subscriber. They'd like us to ask you about Hurricane Beryl and the kind of impact we might see in this particular jobs print. How are you framing that? What kind of number will that subtract by from the overall number?
Yeah, so I think it'll have at least some impact, not looking for a huge impact. So if you look, for example, back when you had Hurricane Harvey and Hurricane Irma hitting in 2017, you actually saw a negative payroll print initially. But those were much larger storms, I think, that you saw impacting across the entire survey period. So the hurricane hit in the second week of the month. And so potentially you could see workers who were maybe out following the hurricane were still on the payrolls during the first part. So we're not looking for as big of impact, given that some workers are still going to get paid even in the impacted area.
Got it. Sarah, thank you. Sarah House there of Wells Fargo looking for 165 at 8:30 Eastern. That was down from 180, their previous estimate. The consensus call, the median estimate in our survey is 175. Is the mistake trade already building in the last 24 hours? At 8:31, and I said this on Wednesday after the Fed decision, at 8:31, we're going to have a very different conversation. Either it's going to be one, yes, growth scare, mistake trade on, or the other, things settle down and we all get a nice weekend.
And so much of that just might hinge on what the unemployment number is, just because of this hyper focus on it. I know 4.28% is what triggers the SOM roll. You can argue whether it's important or not, but just so much has been baked into this, so much anticipation of a slowdown. If you get a whiff of that, if you get even close to that, you have the feeling that this is a bond market that's ready to run away with it, and an equity market that's changed to bad news is bad news and will sell off alongside it.
Well, I think that's what Sarah's waiting for, to find out exactly what that unemployment rate might be. Does that mean outright deterioration versus what many think right now potentially is normalization? It's a big debate.
You know, Jeff Rosenberg of BlackRock went against the grain on Wednesday after the Fed decision, and we're going to catch up with him a little bit later after the jobs number drops. And he thinks the biggest risk today is that actually you get a blowout jobs number. Real strength. We'll see. We'll catch up with Jeff shortly after the number drops at 8:30 Eastern Time. We'll catch up with Mohammed Al-Erin next on the programme of Queen's College, Cambridge. He's going to be with us through the next 2 hours from 7 Eastern through to 9 o'clock. We'll be speaking to Priya Misra of JPMorgan, Ed Mills of Raymond James, Nela Richardson of ADP. And we have to say thank you to Danny Berger. Thank you, Danny.
It's a pleasure.
It's good to see you. Quite a session.
I'm sticking around. I'm going to read some news for you.
OK, good. We'll get your thoughts on a payrolls report a little bit later as well. Why not? Why not? From New York City this morning, good morning. It is Payrolls Friday. The number we're looking for is 175. A bit of a growth scare brewing over the last 24 hours following ISM manufacturing and jobless claims, both of which moving in the wrong direction. Equities lower. We're down 1 full percentage point on the S&P from New York. Good morning.
The labor market is showing some weakening. It's had considerable cooling taking place.
The labor market is not necessarily on the precipice of breaking. We have seen a loss of momentum, but we're still talking about a circa 4% unemployment rate.
I don't know if unemployment is going to stay there or not. It often moves up slowly and then moves up rapidly.
We think unemployment probably ends around where it is now. The labor markets are normalizing.
Labor market renormalization should not be mistaken for any labor market weakness.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
90 minutes away from the payrolls report, the second hour of Bloomberg Surveillance starts right now. Let's start with the price action, and then we can turn to the estimates. The price action, negative. It continues on the S&P 500. We're down across the board, down by more than 1 full percentage point on the S&P. On the NASDAQ, down by 1.6. On the Russell, the small caps, down by 1.9. At the bond market, the rally continues for a 7th consecutive session. Yields lower over that period by more than 30 basis points on a 10-year maturity. The 2-year dropped 50 in the month of July alone. That move continues. Yields lower at the front end by 3 basis points, 4.12 on 10s, a break of 4% in the last 24 hours. Your 10-year, 3.94. I promise you the estimates, so here they are. Going into payrolls, just around the corner. 175 is the median estimate in our survey. On unemployment, 4.1%. The question, particularly after the weakness of yesterday, ISM manufacturing, jobless claims, is this a head fake or the real deal? With us around the table, the real deal, Mohammed Al-Aaron of Queen's College, Cambridge, with us for the next 2 hours. Alongside Anne-Marie, I'm Jonathan Ferro. Mohammed, we've got to go to you first. Head fake or the real deal? What is this?
I think the US economy is slowing faster and in a broader sense than most people anticipated, including the Fed. And I think that the market is catching up to that possibility, which has become a probability.
So I've said repeatedly, I've asked repeatedly, welcome cooling or unwelcome deterioration. Is this starting to sound more like the latter than the former?
It is the latter. There's no need for us to have an excessive slowing in the economy. This remains quite a robust economy. And if we do get it, it is because the Fed was late in recognizing that the economy is slowing.
Now there's a debate if the Fed needs to cut deeper when they go in September. Do you think that they should, in September, go to 50 basis points instead of 25?
I think if they go to, I'm laughing because so many people now are starting to say 50 basis points. To start with a 50 basis points cut means you've made a policy mistake. And this is the Fed that surprised a lot of people by having to hike 4 times in a row by 75 basis points. So they were late starting, and if they cut by 50, they will signal that they're late starting to cut. I think it would be a mistake to cut by 50, but the fact that some people are talking about it, I think, is where the information content is right now.
We've got lots of time with you this morning. You'll be with us through the 7 o'clock hour into the 8 o'clock. We'll go through the jobs number together. I just want to sit on what I think has been the biggest piece of your call, which is listen to corporate America. It worked the first time. It seems to be working the second time. What did you make of the tone of that news conference with Chairman Powell early this week, where he appeared to dismiss any evidence, any signs of weakness?
So I think he was trying to strike that delicate balance, first explaining why it is they didn't cut, but signaling that they're likely to cut. And he on the whole, actually, he struck it quite well. He did come across more dovish than the statement. And you saw the market react in that way yet again. And that is his habit of coming across more dovish. But I understand, it's not like the Bank of England. The Bank of England is very clear. 5 people voted for, 4 people voted against.
Yeah.
It's very... He responded by saying, oh, no, it's really good that everybody votes the same way. Actually, it's not good that everybody votes the same way because you don't get a sense of how difficult this judgment call is.
I wonder if we get a sense of that in these speeches over the next few weeks from Fed officials. Mohammed's going to stick with us. Your lineup for the next hour, Priya Misra of JPMorgan. As weak data spooks bond investors in the last 24 hours, we'll catch up with Ed Mills of Raymond James as Kamala Harris prepares for a swing state tour. And we'll catch up with Nela Richardson of ADP, looking ahead to the jobs number. We begin with our top story, weak data fueling a bond market rally going into the latest US payrolls report. Priya Misra of JPMorgan writing this: given recent data, all markets are getting a little nervous about a recession, and I think we'll react more to a downside surprise. The labour market is softening, and we are all focused on whether it is slowing to trend or below. Priya joins us now for more. Priya, it's good to see you. Let's get this conversation started. We've got a lot of work to do. We've had a massive rally in the bond market. What's the limit of this rally, given the move we've already seen at the front end of the curve on a 2-year and further along the curve on a 10-year?
So I think if the soft landing persists, I mean, we've talked about how narrow that path is. I think it got narrower in the last few weeks. But if we remain in the soft landing, I think rates are pretty fairly priced. I mean, the 10-year, 375, 4.25. We were kind of right in the middle of that. If the economy slows down more, there's a lot more room. I mean, look at the end point. We're also focused on when do they start? Do they go 50 or not? Look at the end point. We're priced for 3.2. That, to me, is a soft landing terminal rate. If the economy slows down and the Fed realizes, well, maybe they should have cut earlier, they need to cut faster, they're going to cut a lot below that. So I think then you're talking about the 10-year getting closer to 3%. I don't think we're there yet. So which is why the data over the, I mean, end of cycle data is always difficult. You're getting mixed signals. You have to, figure out the signal from the noise. But if the economy starts to weaken, bond yields are going a lot lower, particularly in that front end, because we should start to price in the Fed taking rates into not just neutral rate, but sort of into accommodative territory.
Priya, you just mentioned that the balance of risk for the employment report coming up is that it's even weaker than what people anticipated. There's the other view, look how much bond yields have moved. The balance of risk is the other way around. The technicals now have changed completely in the market. So how do you judge the balance of risk for today's numbers?
So I agree. We've had a really big move this week. So if you get a 200, 250, I think we should also debate what is break even. Back in the day, we would think 100,000 was break even. I would argue it's closer to 200,000. So if you get a 300,000 payroll number, absolutely, I think rates can rise. We can give back some of the move this week. But here's the thing. We're debating whether the labor market is slowing to trend or it is slowing unequivocally. The economy is slowing, the labor market is slowing. So we're not talking about rate hikes. So I think it limits how high the 10-year can go, how high the front end can go. The Fed is getting ready to cut rates. I think it's a series of cuts because here's what's fascinating. The Fed, Chair Powell has said it multiple times, the labor market is back to where it was pre-pandemic. Look at where monetary policy is significantly restrictive. So I would argue, even if, let's say the economy is not slowing that much and we stay in the soft landing, the Fed has a lot of room to get rates to neutral. Maybe it's 3, maybe it's 3.5. It's not 5.5. So I think it's still somewhat asymmetric.
So how quickly should they be going there? Are you in the 50 basis point cuts in September?
So I would like the Fed to cut 50, start the process. Look at the starting point. I don't think they're going to get there because it's going to spook the market. What does the Fed know that we don't know? So I think they start 25, but I think we should take them at their word. Things slow down more. The unemployment rate rises to 4.5. I think they speed up. Just like the hiking cycle, remember, was not a series of 25, as you said, 25, 50, and then a series of 75s. You might have the cutting cycle, and I think the cutting cycle is going to look very similar, where they start slow, and then if things worsen, they're going to really crank it up.
So that means September, November, and December.
I don't understand the let's go really slowly. If the economy is back to normal, get monetary policy to normal quickly. And I think the market's starting to price that in. What we've done is we haven't taken down, the market has not taken out terminal rate estimates that much. They've moved the cuts into 24 and 25. That makes sense. If you want to normalize policy, go every meeting, go 25 every meeting. And that gives you the option that if things start to slow down, you can really, start to accelerate.
You write that the market will react to a number below 150,000. We had Juckes, Sarah House on the last hour. They said below 100,000 would really be a dramatic market move. What do you think would be so low that really starts to unnerve the Fed and maybe we would see a bigger cut in September?
I think below 100 will do it. And it's the totality of data. So we've got the claims number. It's the best high-frequency measure of the labor market. It's been inching up. So if that continues, I think you could start to think the Fed. And again, the Fed can try and finesse the message by saying we're at 5.5. So we're not panicking. We're not going to zero. But we're just normalizing. The 50 is just the start of normalization. We know monetary policy works with a lag. I mean, that's the one thing we've all learned. We've lived through the lags, these long and variable lags. But I think, yeah, if you get a below 100, Joel's continuing to fall, ISM services, that ISM manufacturing was scary. If services is also that weak, I think then that 50 talk just gets a lot louder.
What was scary about it? What component of it really spooked you yesterday?
I think new orders, employment. We know manufacturing is weak, and that's why I'm waiting really for services, because the economy is not really a manufacturing economy, but it tends to be, ISM manufacturing tends to be more cyclical, tends to lead the move. So the broad-based slowdown and, at cycle lows, you start to worry, is that a leading indicator? And we've been getting a bunch. Here's why you don't want to overreact, because you look, is there overinvestment in any sector? Not really. Corporate balance sheets look healthy. So, which is why I think we're still in a soft landing. But soft landings are all about risk management. And the risk management now, I think, argues for hedge that downside.
So help me understand. 2 to 3 weeks ago, the narrative was they have plenty of time. The economy is fine. Of course, they won't cut in July. Now, suddenly, they should have cut in July. They could do 50 in September. What has changed? What is it that has made this narrative change so radically?
So markets do tend to overdo things, or maybe there's an element of that here. But I will say, if you look at the inflation data, we've seen very welcome slowing. The only thing that's high is really shelter. And you look at the totality of data, the one thing that was holding all this up was the job market. That's showing signs of slowing. Again, I think we don't know enough whether it's slowing to just, are we going to normalize? And that's the big question we're all facing. Is this normalization? Chair Powell said it many times. I think he hopes, we all hope this is normalization. But labor market slowdowns are often non-linear. So if the unemployment rate starts to rise, does it just rise a lot faster? And then what does a 25 basis point cut do? I think that's why the market, and I'm hoping they can be a little fast, get to some sort of normal level, neutral, whatever that is, and then they can respond better. At least reduce the level of restrictiveness. We have very restrictive policy right now.
Let's get to the calendar. August 2nd today, jobs report. August 14th, CPI report. September 6th, first Friday of that month, we'll get a jobs report. September 11th, we get a CPI report. September 18th is a Fed decision. And that Fed decision is not just about interest rates or the news conference, it's about new projections. And you talked about finessing the message. They've got to finesse the forecast, don't they? The unemployment rate they've got for year-end for 2024 is 4%. The unemployment rate they've got for year-end 2025 is 4.2. And there are some people who think we might be there today in about an hour and 20 minutes. Now, I wonder what that looks like in September. What does that get revised to?
I think the projections are a function of appropriate monetary policy. So we should look at the dots along with the projections. They might keep the projections at 4.2 and just speed up the rate cuts. Because if they think that monetary policy will work, they can cut rates and keep us in the soft landing. And so you may not have a big increase in the unemployment rate. What would worry me a lot is if they have an increase in the unemployment rate and they don't have a lot more cuts. That means they're telling you they're okay with a slowdown. I mean, that's not what Chair Powell's saying. So I do think they're going to hope that they can cut in order to keep us there. But that's the big question. Are we less interest rate sensitive today? And I would argue we are. And we need time for interest rates to work. So if they don't start fast, that unemployment rate's going up.
Pause. You think even if they do start cutting, it's not going to be enough to slow this down?
It's tricky. I think we don't know. But we should think about the scenario where they cut even 50s at 5.5. If they're cutting 50 a quarter, or even, I think 50 a meeting, you might just about get there. Stop QT. It's odd that they're also doing QT on the other side. That's tightening monetary policy. They need to ease, unless you get big fiscal easing, and that's the other. We're on a knife edge right now. The economy, the elections. So there's a lot of unknowns. But I think we should be looking at the outcome where you don't get any more fiscal easing and monetary policy is adjusting too slowly.
Priya, it's great to catch up with you. Priya Misra of JPMorgan. Mohammed, on the money as always. How quickly this conversation has changed in a couple of months.
I'm stunned. I'm absolutely stunned at how quickly it has changed. And a lot of what you said, Priya, we knew. We knew that monetary policy adds with a lag. We knew all this stuff, but it's amazing how the market has gone from lower interest rates is a good thing for credit and for equity risk, to lower interest rates signals something really bad for credit and equity risk.
That's a major change as well in this conversation. This bond rally continues. Equities are still selling off. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. ExxonMobil reported earnings that beat expectations. Shares just up 0.7%. The company's acquisition of Pioneer Natural Resources pushed oil and nat gas output to a record. It does provide assurance to investors that Exxon is well placed to push through its planned 15% ramp up in share buybacks that would put it to $20 billion a year. Exxon is the best performing major oil stock so far this year. Now, Politico is reporting that chip maker NVIDIA is facing antitrust investigations. The probe is focused on the company's business practices and the acquisition of a startup called Run AI. Run AI helps users do more processing with fewer chips. Regulators, though, want to know if NVIDIA is just simply buying the company in order to bury it. Both the DOJ and Run AI did not comment when asked by Politico. And JPMorgan CEO Jamie Dimon writing in a Washington Post op-ed that the private sector should, quote, have a seat at the table in a future presidential cabinet. Dimon writing, a president should put the most talented people, including those from business and the opposition party, into their cabinet. The editorial leads with the call for, quote, strong American leadership to bolster U.S. influence and strength, saying the country is at an inflection point and that could determine the fate of free and democratic nations for decades. And that's your brief, John.
Danny, thank you. That's the sound of Priya running out of the room with no comment. Up next, new dynamics in play for November.
The common theme, in my view, is this sort of populism that has taken on a very nationalistic fervor. Even if the other side, if Kamala Harris were to win, she's not Joe Biden. So let's see what that means.
The conversation's up next, live from New York City. Good morning. If you are just tuning in, welcome to the programme. Pulling back a little bit on the S&P 500. I say a little bit because we've got used to these kind of moves in the last 24 hours, haven't we? We're down by 1.2% on the S&P. The rally continues in the bond market. Yields are lower by 4 basis points. A break of 4% yesterday. 493.57 on a 10-year going into payrolls later this morning. Under surveillance this morning, new dynamics in play for November.
The common theme, in my view, is this sort of populism that has taken on a very nationalistic fervor, and our country is not immune from that either. I look at the left, and they have always been about populism versus business and Main Street. We're going to be set up in the Republican Party for a real debate now going forward. There is no incumbent running. So even if the other side, if Kamala Harris were to win, she's not Joe Biden. So let's see what that means.
Here's the latest. The Harris campaign announcing a record-breaking fundraising haul of $310 million in July. That's more than double the nearly $140 million that Donald Trump's campaign pulled in. Ed Mills of Raymond James has this to say. Harris's campaign launch arguably could not have gone better for her. But we're on the cusp of her first major governing decisions with her selection of a vice president. Ed joins us now for more. Ed, we've got some time this morning to go through the VP stuff. I want to start with this column in a Washington Post this morning. I'm sure you've seen it, Ed. It's from Jamie Dimon at JPMorgan. I'll share the quote with you so our audience who are just joining us can see it as well. The private sector has huge wells of expertise and produces 85% of our nation's jobs. It should have a seat at the table. Yet in recent years, government leaders have often failed to engage those in industry. A president should put the most talented people, including those from business and the opposite party, into their cabinet. Ed Mills, is that wishful thinking from the CEO of JPMorgan?
Well, John, I think it depends on who wins. I think there has been a frustration in D.C. I've talked to a number of folks within the financial services industry where they feel as if experience within industry is actually something that makes it almost impossible to get Senate confirmation on any position that requires to go through the Senate Banking Committee where Elizabeth Warren serves. I do think that Jamie Dimon is setting up to possibly be a Treasury Secretary in a Trump administration. And one of the big debates that I've had with clients at Raymond James is if Trump wins, will there be people that join his cabinet, join his administration that the market likes, like we saw back in 2016. And I think op-eds like the one this morning, John, say the answer is most likely yes. And I do think, to former Majority Leader Cantor's point, Kamala Harris is very different from Joe Biden on a lot of things, and personnel equals policy. I do think she would be more open to certain individuals serving in the administration. A big debate over, does FTC Chair Lina Khan stay? Her term expires in September, or would she put in someone that is more tech friendly, given the fact that she's the former senator from California and has strong ties within the tech industry?
Ed, why do you think it's a Treasury Secretary position under Trump? He doesn't mention Trump or Harris in this op-ed, and we've seen this individual talk badly about Trump openly, but also give him credit when credit is due. It's not like he is very obvious about which team he's playing for.
Sure. I think I make those comments based upon what he said back in Davos, where he seemed to open up this opportunity when we've gone through possible list of Treasury secretaries. We put him on the list in the Trump election. I would not have put him on the list in a Biden reelection. I think it's a maybe should Harris win. So, Anne-Marie, it's an important point. I just think that given some of the comments that he's made, it's slightly more likely. And talking about having someone from the other team, Diamond is viewed kind of in D.C. as a Democrat. So the other team would be the Republican Party.
Based on the comments we've seen from him repeatedly, I think he'd say the team he's on is the United States. And that's the point he's trying to make in the piece this morning. Ed, the difficulty I have with the vice president, and I think a lot of people do, and it's still early days, and we'll find out more about her position on a range of things. Ed, it's difficult to understand what she actually stands for, what the policy platform will be, because as far as we understand at the moment, there's been some distance created between her and the sitting president, some distance created between her and her views back in 2019 when she was running for 2020. What's your understanding of what this policy platform might look like?
Yeah, John, so first and foremost, I think it's easy for her to say that this is a continuation of the Biden-Harris administration, should she win. And the Biden administration would point to the different successes that they've had on the Inflation Reduction Act, the bipartisan infrastructure bill, and what Biden was trying to make as a campaign promise for his second term is the full implementation of those. So that's where we start. But you are right. She was only in the Senate for a relatively short period of time compared to what we've had for other candidates. With Donald Trump, we've had him as president for 4 years, so we have a much greater understanding. When we go back to her time as Attorney General of California, what stands out the most is her settlement with 50 attorneys general on a foreclosure settlement against the largest banks in this country. But besides that, it's a lot of things that are popular within the Democratic base. She has led on reproductive rights. But in politics, what I've always said is that when you're explaining, you're losing. So right now, she is in a honeymoon period of her campaign to go out there and launch that 10-point plan to go through kind of the details. They think that gets her into the explaining part of the conversation. They'd rather have the honeymoon last as long as possible. So the fewer policy details you give today, the easier it is for the honeymoon to continue versus really going through this conversation as to why did the comments about fracking or Medicare for all back in 2020 could be so different than today? Well, a lot of that's because states like Pennsylvania are probably the tipping state, and it makes it much harder to win in swing states, win in states that have a lot of fracking, if you keep those former positions. So just allow the kind of independent validators to make your case and step back and see how long it can be until you have to take some of these positions.
Ed Mills of Raymond James. Ed, thank you. Appreciate the update. Mohammed, you've been following this conversation. You've been following the news over the last few weeks. What do you make of all of this? What's your view of things currently?
So I think that the vice president's campaign is gaining traction much faster than anybody anticipated. Ed didn't mention the $310 million in July that she raised. That's a lot of money, and that's quite a reaction from the base. So suddenly we've got a really interesting race going on.
I've heard this phrase repeatedly, Anne-Marie. Honeymoon, VP pick, honeymoon continues. Keep going to these campaign rallies, big audiences, drum up all that enthusiasm. And then we get to the explanation, the explaining, as we get closer and closer to the DNC.
The DNC obviously is going to be this celebration. They're going to have a ticket, and then the real election starts. You really will have, she'll have to sit down, she'll have to answer in an interview policy questions. If she wants to win Pennsylvania, she needs to decide whether or not she wants to ban fracking or not. Because that's going to be replayed constantly on Trump ads.
I go back to what Libby Cantor told us all. Good friend of all of ours. Get a cocktail, go to the beach, and come back on Labor Day. After Labor Day, all right? And then we'll talk about politics. From New York, this is Bloomberg. So if you thought July was exhausting, welcome to August. Here we go. Check this out. Down by more than 1% across the board. On the S&P 500, negative by 1.2. On the Nasdaq 100, down by 1.7. On the Russell, the small caps, up 10% in July, down 2% this morning. We are heading towards a third week of losses on the S&P 500 unless we get a turnaround sparked potentially by a payrolls report dropping in about 60 minutes' time. Switch on the board, turn a page, and let's get into the bond market. We'll sit on the 2-year and a 10-year. Let's start with a 2-year, down to 4.1%. We're down 4 basis points. We were down 50 in July. We add to that move. We dropped 4 on a 10-year, 7 consecutive sessions. This maturity has been rallying. Over that period, that yield has dropped by more than 30 basis points. We're down 5 this morning to 392.81 after breaking through 4% for the first time since spring of this year. I want to turn to foreign exchange. As yields drop, we've engineered this massive unlocking of yen strength, promoted and endorsed and encouraged by what we heard from the BOJ earlier this week as well. We're through 150, we're down to 148.93, we're down about a third of 1%. Dollar yen down for a 5th consecutive week. That is another week of yen strength, and that has unlocked some real weakness in the Japanese equity market. Take a look at the top picks, the Nikkei 225, pick your poison. It's all poison. Over the last 2 days, we're down hard by something like 8% on the Nikkei 225. Mohammed, we're down by almost 6% in today's session. What do you make of what's developing, not just in the United States, but worldwide in places like Japan? Because it hasn't just been a US market move, it's been global.
Yeah, but I think Japan is an outlier, and that's why you're seeing the much bigger move, because the equity market there is having to cope both with a weaker currency, with a stronger currency, and higher rates. And these two things are adding or amplifying the pressure that's coming from outside. Ironically, that's what they needed to do. They really did need to normalize faster. And we got that message clearly this week when the governor said that a weak currency is problematic for inflation, and he sees no limit, no ceiling to that. So it doesn't surprise me. They are doing something they should have done earlier, which is normalize at a faster rate.
Based on the guidance we got from Governor Ueda, it looks like the bar to go again is pretty low, looking for another rate hike. We spent a number of months this year talking about the prospect of central bank divergence, and at the time we were talking about the ECB versus the Federal Reserve. I'm wondering more now about the BOJ versus the Federal Reserve, real pure divergence. How far do you think that could extend?
I think in that case it could extend quite far. What I think cannot extend that far is between the Fed and the ECB, the Fed and the Bank of England. That trades in a similar world. But with Japan, divergence could extend quite far.
Dollar yen right now, 148.97. We're negative on that currency pair by about 1/4% or so. That's the price action. I just want to turn to some top stories for you. Under surveillance this morning, let's start with this one. President Biden vowing more US support to Israel. This coming as Israel faces fresh threats following the assassinations of Hamas and Hezbollah leaders. At the same time, Biden pressing Netanyahu to move forward with ceasefire efforts. How much progress are we going to see in the next few days?
Well, I think what is interesting is you see Biden really leaning into foreign policy issues right now. He is a lame dunk president. If he's going to have any legacy in the next few months, it's going to be to try to shore up some of these deals, try to put a bow on some of these negotiations he's been working on. What I find interesting is this comes after Ismail Haniyeh was assassinated. So Biden also said when he was briefing reporters that Israel should take this deal, they should move on it fast. He said that it hasn't helped that this individual was assassinated. So potentially got on a phone with Netanyahu to say, yes, we're going to send you more material, but what you did actually didn't help in these negotiations. Also, what I find interesting, the end of May, Biden came out with this ceasefire proposal, and I looked up the text this morning because he's saying Israel should move on it. Biden presented the ceasefire proposal at the end of May saying Israel has offered a comprehensive new proposal. Well, which is it? Is the United States pressuring Israel to take this proposal, or was it the end of May Biden saying this was Israel's proposal that they've outlined this 3 steps?
Kamala Harris is not exactly known for her foreign policy expertise. How closely is she going to be aligned with the president in the coming days on this issue, the coming weeks, the coming months for the rest of this campaign?
If he gets a ceasefire negotiation, she's going to want to bask in that. And that's going to be very helpful when it comes to young voters and progressives. But you have seen her try to take a slightly different tone when it comes to Netanyahu. And that's obviously especially important with Democratic politics heading into November. And you saw last week she had a separate meeting with Benjamin Netanyahu. So Netanyahu comes here and he has 3 different meetings: Biden, Harris, and Trump, because November 6th, it does not unclear who he's going to get, but he still needs to deal with the sitting president at the moment.
I think we're all trying to figure that out, that's for sure. I want to turn to China and talk about Apple. So Apple's seeing some poor sales in China, despite a generally upbeat earnings report from one of the biggest companies on the planet. The company predicting that its new AI features will spur iPhone upgrades in coming months. It's a different story for Intel, the company delivering a grim growth forecast and plans to slash 15,000 jobs. Mohammed, let's start with Apple and the weakness in China. They would attribute this to the FX market and the strong US dollar, and perhaps we can run with that argument. But we've seen this repeatedly in China over the last few weeks from corporate America, and I would say from corporations worldwide. What can they do to address this weakness? Because what we hear, particularly over the last week or so, is that they've got some room to move on the fiscal side, but they want to wait to see what happens in the election before they do it. They want to keep that dry powder for 2025. What's your interpretation of what's developing there?
So unfortunately, China is going back to its old game of trying to use the global markets to turbocharge their own growth. And we see this in exports, we see this in the currency. What they need to do, and I think they know that, is they need fundamental reforms. And they understand what sort of reforms they need. They need to develop new engines of growth. And right now, they do not want to suffer the consequences of structural reforms. And what are the consequences? The benefits are long-term, the costs are upfront. So what you're seeing them is going back to some old place. Look, China is going to be slower for longer. People, I don't think, fully realize this. Apple has an extra disadvantage. It's an American company. So you are looking at 2 headwinds for American companies. One is from the economy, and 2 is from the fact that China is slowly diversifying away from American companies. The Chinese consumer is diversifying away.
That's the important point here. The Chinese consumer is backing away. Is that a trend that you think has legs? Is that going to be difficult for American companies that are ultimately looking at China, have a big presence there and are looking to sell to that Chinese consumer?
I think any American company that's not putting this into its growth projections is making a mistake. Yes, that's going to be around for a while.
That's corporate America. Can we talk about companies that have to engage, countries that have to engage on this issue as well? I remember an opinion column you wrote maybe a number of years ago, and you talked about the fence sitters, the countries that wanted the security blanket from America and at the same time wanted to have that presence in China. How sustainable is fence sitting in the world that we're going into now?
So it depends who you are. If you're India, if you're Brazil, if you're Saudi Arabia, if you're the United Arab Emirates, fence sitting is sustainable. You can play both sides. Why? You've got something special. If you're New Zealand, Australia, Singapore, Mexico, fence sitting is not a sustainable approach. And then you've got a third category that we never talk about, is that countries that are going to be left out completely. Think of some countries in Africa. So what you're going to see is the middle powers, some of them being able to fence sit. A second category will be forced to make a choice at some point. And then a third category that get the worth of both sides.
What about a fence sitter like Germany? Pressured by the United States. Are they a fence sitter? They're pressured by the United States to put up the walls, yet they're desperate to be in the Chinese market.
Yeah, I don't think they're going to be a fence sitter long term. And Italy is another example where the Prime Minister is trying to fence sit. I think ultimately Europe is going to align on national security rather than economic.
Interesting. That's the latest on China and Europe. Let's turn to this. I want to get to Amazon earnings and the latest from big tech, delivering some disappointing results, telling investors that profits for now will take a backseat to heavy AI spending. The company also providing conservative revenue guidance for the third quarter as well. This was a line that came from the CFO. We're seeing a lot of the same consumer trends that we've been talking about for the last year. Consumers being careful with their spend, trading down, looking for deals. Poonam Goyal of Bloomberg Intelligence joins us now for more. Poonam, we have heard this repeatedly. And Mohammed Alarin, who's with us around the table, has talked about this repeatedly as well. P&G, slower price increases. Kimberly-Clark, slower price increases. Pepsi, consumers more challenged. Internationally, Nestle, value-seeking behaviour. Poonam, how is Amazon dealing with that at the moment?
You know, Amazon's focused on price, so you're absolutely right. The consumer remains selective. They're trading down, and they're playing for value. And in that instance, Amazon has to discount more. And we saw that over Prime Day just recently. And we expect them to continue to push the pedal on price, which is in part of the reasons for their weaker operating margin guidance for the third quarter.
Poonam, I want to focus a little bit on all the investments that we're hearing about and what that does to the structure of the industry. So if the big ones, if the mega companies are investing so much money, what happens to the belly of the curve? What happens to the mid-sized companies that are trying to establish a footing here?
I think, the bigger you are, the more power you have to invest, the more capital you have. So you're going to grow faster. When it comes to the smaller, the middle companies, I think they're going to have to find a way to lease some of this infrastructure, some of this technology investments, because they don't have the capital to invest like an Amazon or even a Walmart. And I think they will be challenged. And we're seeing that already. The investments that Amazon, eBay has made in technology and AI, many of the other retailers that I follow, they're nowhere near that today. So they're scrambling, they're picking and choosing where they invest, taking small pockets of opportunity.
So what do you tell people in Washington that are concerned about consumer protection, that are concerned about competition, that are seeing a natural tendency for the big to get bigger and the smaller to get squeezed?
I think they have to, figure out the big can't get bigger through acquisitions anymore. It's very hard for an Amazon to buy something today. So the growth is all organic. That said, will there be pressure from Washington on allowing companies like Temu and Shein, which are creating this added pressure, especially on the consumer side, right? With these rock bottom prices, it's really challenging everyone, not just the big, but also the mid and the small sized businesses, because you can't compete with those prices unless you're big and you can afford to take the loss.
The Amazon CEO, speaking to investors, said that it's a pretty tough experience with how much is locked behind cabinets. Currently, he's talking about U.S. drugstores. We have to press a button to get somebody to come out and open the cabinets for you, and shoplifting going on in the store. How much are the issues that Americans face at drugstores actually benefiting Amazon right now?
So Amazon benefits largely from convenience. And yes, it is a little uncomfortable to, have to go into a store and have to ask someone to open up these cabinets. It's not the best shopping experience. And we are seeing the shift to online really help with that. But that said, it depends on when you need it and how you need it, especially when you're at a drugstore. If you need your medicine in the next 30 minutes, in the next hour, you're going to walk into a CVS or somewhere else. But if you can wait a day, then you can go to Amazon and have it fulfilled, or to any other online retailer.
The retail experience with some of these companies, Anne-Marie, dead on. It's awful. You don't want to go in there. Why would you?
And the CEO is saying the combination of what's happening in the physical real world and how much progress Amazon is making in their e-commerce pharmacy is helping them tremendously, because people don't want to wait around 10 minutes and then have the sales attendant hover over you while I decide which deodorant to buy.
To Poonam's point, you get out the phone, order the toothpaste, put it back down and walk away. Do I want to go into name your franchise, whatever it might be, and get them to unlock the thing to get the toothpaste out? Who wants to do that anymore? It's ridiculous.
Not when you have the convenience of Amazon. A lot of people aren't, and they're stealing their market share.
Big time. I mean, literally, stealing. Poonam Goyal at Bloomberg Intelligence. Poonam, thank you. Appreciate it. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Speaking of not wanting to shop in physical stores, DoorDash shares are up 9.5% pre-market. They reported a stronger than expected profit forecast for the current quarter, and that defied the consumer slump elsewhere. Analysts praised its resilient demand and growth from categories beyond restaurant orders. It expanded its marketplace to include items, again, like grocery, beauty, home improvement, and sporting goods. Now, there's a bit of bad news for bankers in London. Say goodbye to your business class flights. According to Bloomberg reporting, travel is the latest target for UK lenders trying to cut costs. At Standard Chartered, employees now must fly economy for flights under 5 hours. At Lloyd's, they're being told to take public transportation instead of taxis. And at HSBC, employees can only book work travel if they've set up at least 3 meetings a day for that trip. And Andy Murray has ended his tennis career with a quarterfinals defeat in men's doubles at the Olympics. The multi-Grand Slammer jokingly posted on X that he, quote, never liked tennis anyway. Murray had said his summer's Olympic game would be his last event. Over the course of Murray's career, he won 2 gold medals in the U.S. Open once. He won Wimbledon in 2013 and 2016, the first of which made him the first British man to do so in 77 years. And that's your brief, John.
You did, or
Danny, thank you. Appreciate it. If the stuff's free, can you just walk out with it yourself? We should do a package on this. I'll do the camera work. You can go into, say, a CVS.
And
we'll
just-
see how much you can get away with.
And just, yeah,
And then go to a Lululemon, because this takes place at Lulu all the time as well. I see the same thing.
Why are you behind the camera and I'm the thief?
You're
I
going to
think
be,
let's switch.
you want me to be the thief
Yeah,
and you can be the
just in
camera
case.
person. All right, no, I was just going to make the package for you. It's going to do the hard work.
I'm staying out of this.
You probably don't want to get involved in this. I'm not sure management wants us to do it either. Up next on the programme, the data in a driving seat.
I'm not worried about the state of the labor market. That said, the unemployment rate has moved higher. This is typically the tough part to really navigate, is getting that unemployment rate to move slowly up and not just shoot higher in an asymmetric way.
That conversation just around the corner. The jobs report 45 minutes away from New York. This is Bloomberg. Counting you down to the jobs report, about 43 minutes away. The headline number, the expectation about 175. We'll get into those numbers in just a moment. Let's talk about the price action. Equity futures negative by more than 1 full percentage point. The bond rally continues. Yields are lower by 3 or 4 basis points. 393.76. Under surveillance this morning. The data in the driving seat.
I'm not worried about the state of the labor market. That said, the unemployment rate has moved higher. This is typically the tough part to really navigate, is getting that unemployment rate to move slowly up and not just shoot higher in an asymmetric way. So the next 6 months will be really important for the unemployment rate.
Here's the latest. Less than 1 hour until the July payrolls report. This marking the first of 2 jobs reports and 2 CPI prints before the next Fed decision in September. Nela Richardson of ADP writes this. Right now, the preponderance of jobs data shows a cooling but solid labour market. What's playing in the Fed's favour is how low the unemployment rate continues to be, so they can afford to be patient. Nela joins us now for more. Nela, it's good to see you.
Good to see you, too.
What a great day to catch up. Let's talk about the jobs market. You sound a little bit more constructive. Dare I say a lot more constructive than some of the guests we've already spoken to this morning. You've got a load of data in front of you. Walk through what you see and why that gives you a little bit more confidence that this Federal Reserve has some time.
Well, first of all, we're still seeing hiring. And the hiring is robust, and the hiring is different than what it was 2 years ago. It's not just lower, it's less replacement hiring. Remember, this was the time of the Great Resignation. That meant if you had, for example, 30 employees and you owned a small firm, you might have seen 100 employees over a course of a year because your turnover rate was so high. We're not in that situation now. When a firm is hiring today, it's because they're trying to expand their workforce, not replace it. And I think that's an important point to keep in mind. Also, when we're looking at the unemployment rate, we are also seeing more people coming into the labor market, maybe lured by higher wage growth. So this jobs market is robust in some ways, and there are some concerns in the other. I'll just mention one concern that I have is how lopsided our job gains are right now, how positioned towards the service sector, and only certain sectors within the service sector are really seeing strong job growth. I think that is a concern going into the second half of the year.
So now people point to 2 things. Like you say, you're absolutely right that hiring is now more and more concentrated, which makes it more vulnerable.
Right.
And second, the nonlinearity of the labor market, that when it starts weakening, companies feel they're safer, if you like, to lay off people. The consumer gets more cautious, and then you start a process that's self-feeding. How worried are you about that second point, that it's a non-linear behavior when it starts weakening?
You know, I think companies are dealing with a lot of things right now. One of the things when I talk to companies they're dealing with is people aren't leaving. They're staying in role, and you see that in the JOLTS report. They're staying in role longer than anticipated. So companies hired coming into 2004 thinking there'd be more turnover than they actually saw. So the layoffs that you're seeing is not just a firm trying to right size because of margins or profit concerns. There's some of that. But it's also a correction to maybe overhiring a year ago or 2 years ago. So yes, there is a tendency for that employment rate to reflect weakness, but it must also reflect a little bit of self-correction on the part of companies as they're trying to right-size their employment going in, again, to maybe a weaker GDP growth and demand environment.
So take it to the data. We had a 4.1% unemployment rate. Mm-hmm. The Fed thinks we end the year at 4%.
Right.
Where do you think we end the year?
I think we end the year around 4%. I mean, I think that's plausible given the pace of hiring, given how strong consumer demand still is. It's fairly resilient, weakening in spots, but still overall good. And where you're seeing growth in the labor market is in those consumer-facing industries. So yeah, overall, I am constructive, but that doesn't mean that I have rose-colored glasses on this hot summer day.
I would just say constructive relative to the gloom that we've heard around this table.
Well, when you look at the labor market, like I have been for, through the pandemic, we've seen the highs and the lows of this labor market. We've seen very low lows. We've seen highs that were unsustainable. Right now, yes, it's a more normal labor market, but normal isn't always going up. There's a little volatility even in normal. Normal is dynamic in a labor market. And so that's what I think we're seeing in this particular one that is dynamic and very responsive to economic conditions.
We've just had a lot of doom and gloom on the show, people coming on using the R word. Danny was talking about before that even a 10% higher on the unemployment rate to go to 4.2% would trigger the SOM rule. How concerned are you about that, a tick up higher in the unemployment rate?
Always concerned about the unemployment rate, but less now than usual because I really think levels matter, and we started at a record low level of unemployment. So yes, unemployment rates are ticking up, but they're starting from a low level, and I think that gets lost in the discussion of the SOM rule. It matters where you start. And it matters where you finish. And if we're finishing at 4%, if we're finishing under 4.5%, I'll take that. That's very different than finishing at 6 or 7%, which has happened in other recessions. So that context is really important.
You've got some data as well, I believe, on job changes. You talked about people not leaving.
That's right.
What's happening with the wage growth that they can achieve from leaving if they wanted to, if they can find a job?
It's shrinking. In 22...
Quickly?
Yeah, very. In 22, 23, you could actually see maybe a 9% pay bump from your old job to moving to a new job. That's a pretty significant pay raise, especially if you're not making a lot. If you're in an hourly job in a consumer like retail, restaurants, leisure and hospitality writ large. And so the premium from switching jobs has shrunk, which is why people are staying in place longer, why the labor market is less dynamic, and why we might see less hiring over time.
Is that what we saw in job openings, the jobs data, the quits rate, the hiring data? Did we start to see some of that?
Starting to see that. You're not seeing as many openings. You're not seeing as many quits. Quits are down double digits from last year. And so there's no returns for a worker. The returns for switching have been getting smaller over time, and that's what we're seeing in the data.
Fascinating. Nela, appreciate it. Nela Richardson there of ADP, a Bloomberg contributor. I have to say, from my perspective, super rosy, given the doom and gloom. It's all relative. The doom and gloom on this programme over the last 24 hours, Mohammed, we've gone from talking about soft landings just like that. Literally in the last 24 hours, it feels like consensus has shifted towards this hard landing story very, very quickly.
So is it the market leading the narrative, or is it the narrative leading the market?
I think it's the data shaping the narrative, and that's shaping the price action. I do. I've got to say it's the economic data of the last 24 hours that spooked people. The employment component of ISM manufacturing, jobless claims getting to close to 250. The problem that I've got with this, Mohammed, and I think a lot of people feel the same way, we've had a few head fakes over the last 12 months. We've got claims the highest since August of last year. August was one of those head fakes, and then claims pulled lower again. Nela's talking about the dynamism of the labour market. I wonder if that's what's in store for us again. This is another head fake. 8:30 is going to be a big part of this story and how people write about this economy and this labour market going into next week.
Agreed. And let me just say, I wrote down, Nela, normal is dynamic in the labour market. I like that.
It's a great line. Coming up in the next hour of Bloomberg Surveillance, the third hour just around the corner, we'll catch up with Nadia Lovell of UBS, Robert Tipp of PGIM, Jeff Rosenberg of BlackRock, Dana Peterson of the Conference Board. Your jobs report is 34 minutes away. Your estimate is 175k. The previous month, 206 on unemployment. big focus on unemployment. Does it carry on creeping higher? In our survey, we've got it down at 4.1%, in line with the previous month of 4.1%. Mohammed talked about the market narrative. It's running away over the last couple of days, that's for sure. And it's running lower. Equity futures down by more than 1 full percentage point on the S&P, and the bond market, the rally continues. The jobs report, 34 minutes away.
In our eyes, it all comes down to the labor market.
The markets have definitely moved from worries around inflation to worries around labor.
The labor market can turn very quickly, which is why I think Fed officials have to be cautious as they watch these data.
A strong report's probably not going to prevent them from cutting, but obviously a weak one could.
I just feel like the risks on the employment side are increasing to the point that you want to put more weight on that.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
OK, we are 30 minutes away from the jobs report. Let's do one thing first. Let's check out the price action, then we'll get to the guesses. As for the price action, still negative on the S&P 500. We're down across the board. On the board right now by more than 1 full percentage point on the S&P. Down by 1.8 on the Nasdaq. Down by 1.6 on a Russell. The small caps put in lower. Switch up the board and let's turn to what we're looking for a little bit later. Jobs guesses. 175 is the median estimate for the number that drops in 29 minutes' time. The previous read 206. A big focus on unemployment. Hardly talked about wage growth. Just a big focus on unemployment and whether this continues to climb higher. 4.1% is the estimate in our survey, in line with the previous number. I can tell you one bank looking for 4.2. It's Citi. Citigroup and Andrew Hollenhorst. And Citi just published. And this is the title of the piece. And Mohammed, you mentioned this in the last hour or so, how quickly this conversation has changed. Citigroup today are looking for 150K. They're looking for unemployment to get to 4.2%. And the title of this piece today is 75 basis points of cuts for 2024 might be too few. How quickly has this story changed in just a couple of weeks?
Incredibly quickly. I mean, it's amazing. I'm absolutely stunned because consensus is moving so fast. I'm absolutely stunned.
Do you think it makes sense the consensus has moved this far? Is it validated by the incoming information that we've had over the last few weeks from corporate America and the economic data alike?
So I felt, as you know, it should have moved earlier than it did. It's taken time, and now it has moved. It's actually overshot where I am. When I hear people say 50 basis points in September, I think that's really, really difficult for the Fed to start a cutting cycle with 50 basis points. But that's where the narrative is going.
And you think that if they cut 50 in September, they've made a mistake?
Oh, absolutely. I do think they should have started cutting in July. But having said that, I wouldn't say now they should cut 50. I think they've got to be really careful to handle the start of this cycle. You know, you do impact behaviors. We haven't talked about this, but the major issue in the labor market is going to be behavioral. Are people feeling more insecure about their future income, and therefore are they cutting down on their income now? That's going to be the major question.
They're certainly cutting down on spending, based on what we've heard from corporate America over the last few weeks or so. I've mentioned this calendar a few times. September 18th is the next Fed decision. At that decision, they also need to produce some new forecasts. And at the moment, they've got year-end unemployment of around 4%. They've actually got year-end unemployment for 2025 at around the same number. And that's basically where we are right now. For the data points still to come, after 8:30 this morning, August 14th, we've got a CPI report, another jobs report on September 6th, another CPI report on September 11th. A key feature, Mohammed, of your call, and you've written about this over the last few weeks, going into the decision this week, you said we were 2 decisions away from a policy mistake, including the July meeting and the September meeting. And the reason you said that was because you think this Federal Reserve could be pushed away from cutting interest rates based on one freaky CPI print between now and then. After that news conference, when the chairman kind of backed away from this view of saying we're not data point dependent, we're data dependent, has he done enough to convince you, after you blessed him with your thoughts on what the Federal Reserve should do, are you convinced that maybe he's seen your way of things?
So I'm glad he picked up on Christine Lagarde, the ECB president's phrase of we're not data dependent, we are data dependent, not data point dependent. And he stressed that by saying we look at the whole data. He kept on being pushed. Do you look at this? Do you look at that? He said, no, we look at the whole data. Look, John, in your series of dates coming up, let's not forget Jackson Hole.
Sure.
Because our star now becomes much more important. What is your destination? If people are pushing you to start the journey earlier, if they are building in quite a few cuts in that journey, what is your destination? And I think that the Fed needs to spend a lot more time thinking about the destination issues than it has so far.
We can explore that this hour. Coming up this hour, we'll catch up with Nadia Lovell of UBS as the stock market sell-off extends into Friday. Robert Tipp of PGIM, fixed income as risk aversion sparks a major bond market rally over the last 7 days. And Dana Peterson of the Conference Board on why she doesn't anticipate a hard landing. We begin with our top story, the payrolls report just under 30 minutes away. The first of 4 data points that the Fed will be watching ahead of September's rate decision. Nadia Lovell of UBS saying this: the Fed remains on track to start cutting in September with the economy on course for a soft landing. Easing financial conditions should be supportive to a further broadening out of equity market performance. Nadia joins us now for more. Nadia, good to see you. Before we talk about the call in the equity market, can we talk about the call in the economy? Soft landing was consensus for a long, long time, but it feels like things are changing quickly over the last few days. Why are you and the team sticking with that view?
Yes, we do think that the economy is slowing, but this is what normalization looks like. And when we heard from the companies throughout the earnings season, it does feel like things are slowing, but not necessarily deteriorating at a fast clip. So we still think that you can get economic growth in the 1.5% to 2% range in the back half of the year. We do think that the Fed will start to cut, and that will help the economy as we enter into year end. And that should be all supportive for the market. But there are data points coming out of earnings season that did give us some pause around the consumer. So we're watching that closely. But again, it doesn't feel like things are falling off of a cliff, at least not yet.
So what do you make of the change in the market narrative? What do you make of the fact that people have become so negative about the economy suddenly?
We are sort of in this regime again where we're shifting again where, good news is good news and bad news is bad news. And so it's clear to us, and I think to the market, that the rate cuts are imminent. Powell sort of blessed that, thanks to you as well, for blessing the September cut. And so the focus shifts to the data in terms of the growth data. Yesterday, ISM spooked the market, manufacturing. But reality is, manufacturing has been sort of low on average 50 since late October of 2022, right? And to my understanding, the Fed had a preview of the ISM manufacturing data, and they didn't seem overly concerned with it. So again, I go back to things are slowing, but not deteriorating in a fast clip. And I think that the market, again, has gotten ahead of itself, particularly the rate markets that's now pricing in 90 basis points of cut this year. We think that it's going to be 50 starting in September and then another one in December.
So let me ask you about your distribution of potential outcomes. And I've put a soft landing at 50%. A recession at 35%, and then the really good scenario of bigger but not hotter because of positive supply shocks at 15%. So let's focus on the soft landing. Is it a lot higher than 50% in your mind?
I don't think it's much higher than that. But again, whether it's 50 or 60 sort of range, we still think that it's hard to see an economy go from, growing above 2% in the first half of the year to then insignificant contraction in the second half, particularly when you have a labor market that, yes, is softening, but still producing job growth.
Nadia, you mentioned ISM yesterday. Reading through some of these responses, there's serious concern. One food and beverage company, consumer behavior is changing more than normal. Another company saying, we are hoping for an increase in customer demand, or we will possibly need to make organizational changes, i.e. layoffs. If you're viewing in a soft landing, what does it take for you to see in the data to potentially pivot and say, actually, this is going to be a hard landing?
I think you need to see, obviously, the labor market is quite important. We all know that is the last shoe to drop. You are seeing a pickup in claims, but some of the data is quite mixed. I think some of the comments that you're seeing in the ISM has to do with reality is the consumer has been under pressure from inflation. I mean, food inflation itself has been up 30%. Since the start of a pandemic. So it feels like what companies are experiencing, they got used to the last few years of increase in prices and passing that on to the consumer, and the consumer just, continuing to spend. Now things are going back to pre-pandemic trends, and it feels like that companies have forgotten what that felt like.
One of your least preferred sectors, consumer discretionary. Does that speak to that?
So in terms of it, consumer discretionary, our view on that, it's less about the consumer. We just do think that the consumer as a whole is okay, particularly when you look at the wealth effect. You know, you have the equity markets at all-time home equity at record levels. It's more to do with the mix in terms of the sector being skewed more towards goods, and you're seeing a slowdown with that. You're starting to see, yes, some of that weakness translate into restaurants and even a pullback now on travel.
Airlines too, yeah.
Exactly. And even the high-end consumer, throughout the earnings season, it feels like they're throttling back a little bit as well. So it's less more so about like, oh, we think that the consumer is really deteriorating, and more so of the fact that that sector skews towards more goods. Even home furnishing, you know, this past week down a lot as well.
Broadening. You're looking for broadening. Where's it come from? Who's leading it?
The broadening is more coming from some of the, I would say, in terms of some more value, cyclical value, if you will. Think about, like, whether you think about financials and them benefiting from rates moving lower, them benefiting from, you know, Basel III endgame and sort of ease in regulation as well. So that's where some of the broad. Also, I would say even in the industrials, some of the more longer cycle industrials that are benefiting from the increase in spending that we're seeing in AI, electrification, and automation as well. So the broadening that we're speaking of is not small cap per se. That I know has become a hot topic, but more some of the cyclical value.
So if you had looked at the S&P, there were three drivers of what has been strong performance. One is the notion that the sky is the limit for anything that has to do with AI. Second is U.S. economic exceptionalism that's going to continue supporting the broader market. And third, a responsive Fed. And over the last few weeks, we've seen all three being questioned and questioned in a significant manner. Looking forward, the repair process, where does it start? How far does it extend in terms of those three drivers?
So I think the Fed needs to start in September. The AI CapEx cycle, we are not, I would say I put more confidence in that than the other two that you spoke about. Because reality is, again, as you always say, listen to the companies, what have we heard this earnings season is that CapEx continues to go higher. You know, without commenting on single stock, if you look at Microsoft in their 10K, CapEx is be higher beyond 2025. So the hyperscalers are spending a lot of money, and they continue to emphasize that they're rather, you know, like a Meta, Zuck has said, I'd rather have capacity that's not needed today than be late to that. So when we think about positioning in tech, we want to be positioned in those enablers. Those are geared towards AI infrastructure. And let's not forget the utilities are part of that. I think that's where some of the broadening out is coming from. So that's where we will put our confidence in, and sort of like, because at the end of the day, what matters for this market is earnings growth. We think it is going to be continue to be led by tech, and then sort of the Fed behind that.
It was a powerful quote from Zuckerberg, powerful from Alphabet as well. Picked up on the same thing.
Exactly.
Nadia, it's good to see you. Thank you.
Thanks.
Nadia Lovell there of UBS on this equity market. This equity market is lower. We're down about 1% on the S&P 500. The jobs report about 17, 18 minutes away. Let's take the opportunity, just a minute or so, to get you an update on stories elsewhere. With the Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. The president and vice president were at Joint Base Andrews last night to welcome home Wall Street Journal reporter Evan Gershkovich, former Marine Paul Whelan, and other Americans as they arrived home. It was all part of the largest prisoner swap with Russia since the Cold War. In return for the Americans and other prisoners, Russia won the release of Vadim Krazikov, who's been serving life in Germany for killing a Chechen separatist. Germany had long resisted Krazikov's release. Chevron has made plans to move its headquarters from California to Texas. It is just the latest major company to leave the West Coast, complaining of excess regulation. It ends more than 140 years of Chevron in California. The company, though, does have already about 7,000 employees in Houston versus just 2,000 in San Ramon, California. In January, Chevron lashed out at what it called increasingly harsh regulatory environment in California, writing down the value of its assets in the state. And it is day 7 of the Olympics today. 7 U.S. teams compete across 5 team sports. In swimming, there are 3 finals on the schedule today. The attention turns to Caleb Dressel in the 50-meter freestyle race. In track and field, all eyes to Sha'Carri Richardson, the reigning world champion, in the 100-meter dash when she runs in the prelim of that event, plus the men's 100,000-meter final. And the U.S. is still leading the overall medal count, 39. 9 of them are gold. China has 12 gold medals and 26 overall. And that's your brief, John.
We've got a population adjuster table. Going to do that for you next week. Someone's going to do that. No one's going to. OK, we should do that then. Up next on the programme, the morning calls, plus Robert Tipp of PGIM fixed income on the bond market rally heading into July payrolls. That payrolls report 15 minutes away from New York, your equity market lower. This is Bloomberg. It's a question I've thought of, and a question I know that you at home in the office working away have thought of as well this morning. What happens if the jobs number is really strong? How does this conversation change? Ian Lincoln of BMO wrote this just yesterday. I'll share it with you now. NFP represents the biggest near-term risk event, even if it is decidedly one-sided, as investors will be quick to dismiss strength as status quo, while a sharp slowdown could be interpreted as a game changer for the Fed. We're going to find out in about 13 minutes' time. Equities right now on the S&P 500, negative by 1.1%. It yields down by 4 basis points on a 10-year, 393.76. Let's get you some morning calls. First up, Raymond James cutting Intel to market perform. The analyst saying AI PC growth has turned out to be a bigger headwind than anticipated. Intel's getting hammered. We're down 23% in early trading. Next up, Barclays raising its price target on Amazon to $235, keeping an overweight rating. The firm noting that web services, quote, delivered the goods as Amazon faced an extremely high bar for AI investments. That stock is negative by 8.3% in pre-market trading. And finally, Citi raising its price target on Apple to $255. They keep a buy rating. The firm encouraged by early developer feedback on iOS 18 AI features, as well as management's confidence in AI-driven upgrade cycles. That's the story for the morning calls. The payrolls report just moments away. Treasury's rallying into the report as traders boost their bets for Fed rate cuts. Robert Tipp of PGIM fixed income saying this. Exactly how weak is the jobs market? Employment statistics have been moderating, but not evenly. Non-farm payrolls have the potential fill or kill market expectations for a steady streak of rate cuts. Robert Tipp joins us now for more. Robert, I'll start with your own question. How weak is this jobs market? What are you expecting in 11 minutes?
I think that, the market pricing here is looking for rate cuts straight through the middle of next year. So this market is pretty much braced for a steady downturn in the job market that the Fed is going to meet with at least 25 basis points per meeting this year. And on average, we'll hit every meeting through the middle of next year. So, I don't know what's going to happen, but I can tell you that the numbers to date have hollowed out in terms of the cyclical aspects of the economy. There's more government. There's more health care. So you can make the case that seeing a big drop-off in the numbers today is to be expected, and that the Fed, if they get another set of weak numbers, just like 2 out of 3 of the last cycles, could end up cutting inter-meeting.
Cutting
That's
inter-meeting?
why they would do it. Inter-meeting. 2 out of 3. Because if you think about it, they're at 2.5 on growth, 2.5 on inflation. Looking backwards, you could make the case, why on earth would they go inter-meeting? Why didn't they just go? Because the numbers had not broken. But we have seen surveys that suggest things are going down. Their a priori is that they're restrictive, that the growth end of the mandate is at risk. They didn't hammer it. They stayed away from hammering it. But you had people at the meeting talk about, gee, should we be cutting here today? So if it becomes clear as you get today's number, which includes revisions for the prior month, and next month's number, often what happens is these numbers are they break to the downside and are revised down out from under the outlook. And that's why you end up with these intermediate cuts. I don't think that's going to happen. I think it's more likely that we have a very moderate slowdown, aside from any, hurricane side effects and that kind of thing. And that the Fed will, end up in a gradual string of rate cuts, and that we're going to have an orderly bond market that's range bound, albeit in a range that's a little bit lower on yields than what we've seen. But it is wide open. I think that's worth keeping in mind.
So, Robert, as John commented earlier today, we've seen a massive move in yields over the last few weeks. Where do you think the pain trade is now in the fixed income market? And if you can speak to both treasuries and credit.
Sure. Yeah, I think that we have seen these pain trades drive the market because there are so many powerful factors out there. We saw in September of last year, yields go shooting up to 5%, and they would have gone further. The economy was doing pretty well. The inflation was not under control, and the issuance was burgeoning. The Treasury issuance weighing on the market. The Fed stopped that with their verbal intervention. Right now, people are clearly worried about the bottom dropping out from under them like a 2008 scenario. Believe me, I do not think that's what's going on. I think the underpinnings here are solid. Could we have, very modest growth, a big slowdown to something subpar? Absolutely. But I don't think we're going to drop off like we have in 08 or like we saw in the 2001. But that's the fear. I think this is going to be a lot more like a 1995, where they get the numbers under control. They cut on a moderate basis. Because if you think about it, we've just seen a couple good inflation numbers. Before that, we saw a handful of worrisome ones. If it turns out things are moving higher, the Fed doesn't want to be wrong-footed in the other direction.
Hey, Robert, great to get your thoughts. Appreciate it. Robert Tipp there of PGIM, fixed income, with a lot to think about. We often joke around this table that the jobs number we're about to get is the most important jobs report since the last one until the next one. Mike McKee joins us. And Mike McKee, I have to say, this jobs report does feel a little bit more important this time.
It does seem to carry a little bit more weight. I'm not going to say it's the most important one in our lifetime, but certainly the most important since the June report. This is maybe a turning point that we're at here, and that's what everybody wants to, as Robert says, fill or kill the idea, because if it is a turning point, then you're going to maintain the trade that we've had the last couple of days. And if we get a strong report, it'll be interesting to see what happens. And of course, the big question is our good friend Mohammed wrong in saying that the Fed had two meetings away from a policy mistake? We get a bad number today, it might have been just one meeting away from a policy mistake.
So, Mike, what is going on? A few weeks ago, everybody was comfortable. Yes, they can wait till September. There's no reason for them to rush. Now, suddenly, I'm hearing 50 basis points in September. Intra-market, intra-meeting. What is going on?
Well, I think what you're seeing is the panic that one normally sees in markets, especially when there's turning points. As somebody once said, the Fed has a reaction function. Markets have an overreaction function. I don't think we're going to get 50, and I certainly don't think we would get an intermediate cut because, well, first of all, one number isn't going to change anything in their minds. But I do think they're probably more divided at this last meeting than Chairman Powell led on. They all agreed at the end, but what did they say in the middle? We're going to have to check the minutes on that one.
Sintra Portugal, the ECB's get together, it really wasn't that long ago. It's about a month ago. And Chairman Powell spoke in Sintra Portugal and he talked about the strength of the labour market as a reason for them to be patient. It gives them time to wait. I actually also got a sense of that in the news conference that you were in this week, that he didn't really stray too far away from that line. What would upset them today? You look at the jobs report, you look at the estimates in front of us, we get the numbers in a moment. What would upset them today? What would change that?
The biggest concern they have is the unemployment rate. They want to make sure that doesn't keep going up. 4.2% is their view of what sustainable unemployment is, where the neutral level of unemployment would be. 4.3% today would trigger the SOM rule, which would trigger a lot of fear, scare the horses in the markets. Non-farm payrolls would have to be a significantly low number because they've been expecting it to fall. They've been expecting us to gradually ratchet down to the 150s or 130s. So I think it's much more on the unemployment side. Hours and earnings are maybe affected by the hurricane, so we might not get a clean read on it.
We'll talk about Hurricane Beryl as well in just a moment. Mike's going to stick with us and break this down. Mohammed's going to react to it. Coming up, joining us, Dana Peterson of the Conference Board, Jeff Rosenberg of BlackRock. Up next on the program, the most important payrolls report since the last one till the next one. The jobs report drops next. The estimate 175, the number just around the corner. The jobs report 25 seconds away. The estimate 175K. That's on headline payrolls. On unemployment, the estimate 4.1% in our survey. Going into it, the scores. Equity futures down 1% on the S&P, on the Nasdaq down 1.7. Switch up the board and get to the bond market. Treasury still rallying. Yields lower by 5 basis points on a 10-year, 392.62. With the data, here's Mike McKee.
Well, here is a downside surprise that's going to catch the market's attention. 114,000 jobs created last month, according to the BLS. That is significantly lower than the numbers John was just giving you for what was anticipated. The unemployment rate, 4.3%. We hit the SOM rule with 4.3%. So that's going to really move some markets. Let me just give you a quick other numbers, and John will catch you up. Average hourly earnings, 0.2% lower than the 0.3 anticipated. That might be, we're going to have to check, that might be related to the hurricane. Same thing with hours worked, 34.2 down from 34.3. The 2-month net revision to payrolls is only 29,000, but 29,000 lower. And much of that seems to have been in June, because that's revised down to 179 from 206. Manufacturing payrolls up 1,000. That is a surprise. All the pre-indicators, including ISM, suggesting that that was going to be bad news. And I know Mohammed's looking at the labor force participation rate, 62.7. That's up from 62.6 before.
Ladies and gentlemen, we have a growth scare. Let's get to the price action. Equity futures on the S&P down 1.5, on the Nasdaq down 2.2, on the Russell down 2.6. Want to see something dramatic? It's a word that gets overused on Wall Street, but this is a dramatic move. Switch up the board and get to the bond market. Front end of the curve on a 2-year yield. Look at this move on a 2-year yield. We're down 25 basis points. The 2-year is now below where the 10-year was only about 20 minutes ago. The 2 years down to 389. The 10-year at the moment down 18. We're down to 379. Mike McKee, what do you see?
Well, there's one note in this report that I think it's important to put out there, and that is the BLS says Hurricane Beryl had no discernible effect on the jobs data. So this is just what it is, and it is, I think, the way you characterize it, a growth scare is a good way to put it.
As you speak, Mike McKee, dollar-yen gapping lower, down by 1.2%. A stronger Japanese yen at 147.60. If you are just joining us, jobless claims yesterday, higher than expected. ISM manufacturing, lower than expected. The employment component spooked this market. And based on this, for good reason. Payrolls comes in at 114. The estimate was 175. Unemployment comes in at 4.3. The estimate was 4.1. And once I've given you that, you can guess what this market's doing. Equities selling off, bonds rallying, the dollar weaker. Mohammed, I want your view on this as well. What is your view on the totality of the economic data? And at 8:32 this morning, looking back at that Fed decision on Wednesday, how bad was that call to wait until September?
So I'm hearing the market scream two things, John. Growth scare, policy mistake. That is what I'm hearing. That is what you're seeing from the price action. I think the market now fully understands that the Fed may be late in starting its cutting cycle.
I do need to give one small correction here. We did not technically trigger the SOM rule because the 3-digit unemployment rate is 4.253, rounds up to 4.3. You would have had to have 4.8. I just plugged into my Excel spreadsheet the numbers, and we come out at 4.085. So we're very close to the SOM rule, whether that matters or not.
Can I just say this market's trading as if we have triggered the SOM rule and we're already in a recession? That's what this feels like, Mohammed. Is that what it feels like to you?
So Bill Dudley explained it, I think, really well, is the notion that all you need is people to start worrying about something, and then you don't actually have to have it happen. I think people underestimate the behavioral aspects when it comes to the labor market. I do worry, John. I've been worried for a while. You know that. I do worry. Now it's going to be really interesting to hear what Fed speakers say now that they're out of the blackout period and what are they going to tell us.
Let's just take a step back, Mohammed. We've had growth scares before in this cycle. A lot of people have been humbled by how well this economy has held up. Why does this moment feel so different compared to all those other moments over the last few years?
So this is the first time that I have a growth scare. In the past, I kept on saying there's no reason for the US to fall into recession. I think people underestimated the lagged effects of higher interest rates, and these are hitting in a much bigger way now. Chair Powell admitted on Wednesday, speaking to that. So, no, I do worry. I really do worry that we may lose US economic exceptionalism because of a policy mistake. Just to recap, if you are just joining the programme, welcome. We got payrolls just moments ago, 114 against an estimate in our survey of 175. The unemployment rate climbing to 4.3%. The estimate was 4.1. That's unlocked a lot of weakness in this equity market. Already on top of the weakness we've already seen. If we start with the equity board on the S&P 500, we are down across the board. Equity futures negative on the S&P, on the Nasdaq, on the Russell. On the S&P, we're down 1.8, on the Nasdaq 2.5. Look at this move in small caps now. Negative by more than 4 full percentage points. This was the trade in July, up by more than 10%. It was the big rotation, the broadening. We'd get lower interest rates, but we wouldn't get the growth scare with it. And that's what's changed in the last couple of days off the back of this economic data. And check out this bond market move. I want to keep going to the front end of the yield curve, the 2-year. The 2-year yield is lower by 26 basis points to 3.89. And once you've seen that board, you know exactly what foreign exchange is doing. Check out dollar yen. Dollar yen's had a massive week already. Yen strength, you get some more yen strength through this market. Dollar yen gapping lower on my screen to 147.35. To break it down, joining us now, I'm really pleased to say, is Dana Peterson of the Conference Board. Dana, let's go through this jobs market together. You've had about 6 minutes to go through the detail. What do you make of this? A lot of people around this table, including Mohammed Al-Arian, saying this is the growth scare and there's good reason for it. Do you agree?
I think there's a bit of an overreaction here. 114 is still a really strong number. I think we were used to these outsized numbers when we were recovering from the pandemic, where we know millions of people were let go, and then you had to recover them. So this is probably about normal for the labor market right now. And also, when you look at an unemployment rate at 4.3%, that is still very low. And what we're hearing from CEOs is that they're not really looking to let people go. They're holding on to their workers. And we have to remember payrolls are a net number, right? And the thing is that on net, we're still adding jobs here.
So the reason why people say this may be different, and Dana push back on this, is that there are no more buffers for certain segments of the households. There are no more pandemic savings. There's very little credit availability left for them. That it's all about labor income. And if labor income starts falling, then you're going to get a much quicker sort of non-linear reaction in the economy than otherwise. So push back on this notion that the problem is that there are no other buffers in this economy.
Well, it's correct that the pandemic the excess savings is gone, but most people are working who want to work. Wages are still rising year on year, and they're still above what we saw during the great financial crisis and pandemic period. So yes, we are seeing people lever up on debt. All this is suggesting that, yes, the economy is going to slow. That's what happens when you raise interest rates. And the goal was to lower inflation. Now, the Fed is closer to its goal. Inflation's at 2.5%. But we're not there yet. And certainly there are a number of factors that are putting upward pressure on inflation. And remember, Fed Chair Powell said he doesn't want to see material further weakening in the labor market. I'm not sure that this report gets us there. And again, they're probably going to want to see next month's report also, plus the inflation data.
So Anne-Marie read out a few of the quotes that from yesterday's report about companies thinking, do we now have to realign our cost side, given what we're seeing on demand? How seriously should we take these comments?
Well, yes, I think some companies are probably running out of room to raise prices for customers. And that's the goal, right? The Fed wants companies to start cutting prices, which will help lower inflation. So on the demand side, everything is working according to plan. But the risk here is that you still have wages growing pretty aggressively, and that does raise labor costs for companies. And certainly smaller businesses are passing that right along to the customer. So that's leaning against the Fed's desire to get inflation back to 2%. So I think the Fed, certainly there's a signal that September will be the first cut, but I think the Fed will still move very cautiously, may spread out those cuts over time so that it can watch and make sure, yes, the economy is not going into recession, but also that inflation is slowing. Remember, inflation impacts everyone.
How can they move slowly and cautiously, though, if potentially they are behind the curve? A number of analysts came on the show today, Kit Juckes, Sarah Howe, saying it would be a dramatic figure of under 100,000 for them to maybe go 50 basis points in September. Well, if you take into account the revisions as well from last month, we're basically there.
The revisions were small, and again, they were in June. And if you average out the second quarter, we roughly had around 100 and maybe 65,000 jobs added. That's a lot. And I'm not sure the Fed is behind the curve. I think the Fed has been moving cautiously. And even look at GDP for the second quarter. It was stronger, especially domestic demand, and consumers went out and bought cars, and they also continue to spend on services. So that's not really economy, certainly the second quarter, that I would say is collapsing. Now, we do think the economy will continue to slow. And again, that's according to plan. But as long as the labor market, we're still printing positive payrolls and the unemployment rate doesn't rise too much and approach 5%, I think the Fed can move cautiously and potentially 25 basis points for a meeting or even skip some meetings.
Dana, appreciate your perspective. A much more constructive view. Dana Peterson there at the conference board. As Dana speaks, some of these moves fade just a little bit, but a lot of it sticks. Equities are down hard. We'll start with stocks first. On the S&P 500, down 1.8%. The small caps down by 3.7%. Talked about this tremendous rally coming into the front end of the yield curve off the back of these numbers. Switch up the board and turn a page, and we'll look at the 2-year together. The 2-year yield is lower by 23 basis points at 3.92. Mohammed, we can talk about levels, and then we can talk about change. If you look at levels coming into this, 4.3% unemployment, payrolls of around 114. If we were sort of taking the last couple of years off and came back and looked at a jobs report like that, doesn't look terrible. You look at change. The change from where we were and where we are now, I think that's what the market's trading on. And you might, as an economist, sit here and say the Fed's not behind the curve. This market is trading as if it is behind the curve this morning.
It is. This market is taking change as much more important than levels. And I'm interested in Mike's view on this, because you were in the room, Mike, when the chair pushed back and said, well, look at the levels. Look at the levels. Do you think this report makes them worry more, or do you think that they think this is as planned? We're normalizing, nothing to worry about, levels are not that far out of whack?
I think you're probably right that they would say this is kind of what we're looking for. Now, it was a more abrupt move than perhaps they were looking for in terms of overall job creation, but the unemployment rate, while it sounded terrible at 4.3, it's a rounding issue, so it went up by about a half a point overall. And then you look at average weekly earnings, and on a year-over-year basis, it's significantly down. It's down to 3.6 now, and they have been looking for that. They've been wanting to get that below 4%. They've been wanting to get the inflation pressures, particularly in service industry jobs, back down to a level that they think is sustainable. So they'll see good things in this. The problem is to go back to what you said earlier, it only takes, you were quoting Bill Dudley, it's a confidence situation. And that's what people are going to be worried about, is are people going to stop spending, and therefore the companies have to lay people off, et cetera, et cetera.
Stay on the Fed for a minute. When they look at what's happening to the short end of the curve, will they think this is an overreaction?
I suspect they will, and it probably is to a certain extent, because the short end of the curve is pinned to the Fed. And so what people are saying is we think there's going to be a rate cut, but that was already sort of priced in. So now you're going way beyond where the Fed thinks it needs to be. And if they're already planning a September rate cut, this certainly pushes in that direction, then it shouldn't change the short end yields that much.
At the start of the year, there was one trade everyone wanted to put on, and it was the bull steepener. They were all looking for this massive rally at the front end of the curve and this big rate-cutting cycle to begin at the Federal Reserve. And it's been delayed. And here we are in August talking about September. That was back in January, but I can tell you it's developing right now. The distance between a 2-year and a 10-year is down to about 11 basis points. So that yield curve inversion is disinverting, and it does so again this morning. If you're just joining us again, I want to recap these numbers for you. So payrolls comes in much lighter than expected, softer at 114. The estimate was 175. The unemployment rate climbs to 4.3%. The estimate was 4.1. Back on Wednesday, after the Federal Reserve decision and the Chairman Powell news conference, we caught up with Jeff Rosenberg of BlackRock. And I said to Jeff, how will we view this Federal Reserve meeting at 8:31 Eastern time on Friday once we get the payrolls report? And Jeff promised me his response. Jeff Rosenberg joins us now for more. Jeff, what is your response? How do we view that Federal Reserve meeting after seeing this data this morning?
Well, the data changes, and so does the view on what happened on Wednesday. You know, the big reaction here is that almost entirely across the board, this is a disappointingly weak number. So I'm very sympathetic to what Dana was saying earlier. The problem is that markets react to data relative to expectations. And so this is disappointing, particularly the lack of a hurricane impact. You know, there's your 20,000 additional right there. And the issue now going forward is what's priced into the bond market is 50 basis points of a cut in September. So it's this issue of reflexivity now that we're going to get into, and it sets up the Jackson Hole speech really importantly to try to calibrate what is the Fed going to do relative to bond market expectations. You had Dudley on earlier this week talking about how the Fed incorporates that. And if it's priced in at 50, does that mean that the Fed has to go 50? And so the pushback on that is going to be really important around Jackson Hole. But this is now starting to change. And Jonathan, you highlighted what I think is the most interesting market price reaction, which isn't in the bond market, it's in the stock market. And it's that Russell 2000 leading the way downward. So this absolutely, and you pointed out, that had been the rotational trade. If it's maintenance cuts and the Fed can just ease us into a soft landing, then the denominator is what's driving the movement into Russell 2000. But you see the movement today. Absolutely. This is about a growth scare. And now it's about worries that the numerator, earnings and growth and cash flows, are falling. And so you're fleeing the rotation trade into small caps. I think it's a really important observation of market reaction. We can debate whether this is overreaction or not, but the reaction is clearly to almost entirely across the board a disappointing report this morning.
So let's debate this, Jeff, because the Jeff I know would have faded this move in markets, would have been where Mike is, that this is an overreaction, especially the short end of the curve. Is that where you are now?
You know, when the data changes, you change. You know, what do you do? So, you know, I think we've had a little bit of a string here of disappointment on the data, and that's pushing more, you know, Mohammed, on your point about the lags of monetary policy. So it's hard to, you know, stand too far firmly against that. My points in the past, I think, are still valid, that you've had, you know, financial conditions, which we haven't heard as much about from policymakers in this cycle. Financial conditions have been much easier, and that has been supportive. But those financial conditions, as we're seeing today, can change, and they can tighten very quickly, and they can unwind. And so I think that the reaction here, you know, is probably the right reaction. All right, maybe it's a bit of an overreaction, but you're going to push on changing the trajectory from maintenance cuts to calibration cuts, that policy needs to move a bit faster.
So is calibration cut a 50% cut come September? What probability would you put to a 50 basis points cut in September?
You know, I think there's what the market wants them to do, and it's what they will do. I think they want to push back against 50 basis points. I think that's why Jackson Hole becomes important, to kind of get that message out, that the Fed doesn't want to overreact. So I'd put a little bit less probability on 50 basis points than what we're getting in the market today. So I guess that says short term, a little bit of an overreaction. But I think the market wants to push for the 50.
Jeff, I want to talk about this market in a little bit more detail and talk about some of the things that I've heard over the last few months. The Fed put his back. And I've been told the Fed put his back because inflation is coming down and they have the ability to respond to adverse shocks if they need to. Another thing's come up on this programme as well repeatedly, Jeff, and that there are two different kinds of rate cuts, and they're not created equally. You can cut interest rates because you've got disinflation and growth is still holding up, and that's great for risk. And you can cut interest rates because inflation is no longer a problem, but ultimately the problem now is the labour market. Jeff, do you think we've shifted to the latter? And if that is the case, Can you make an argument for markets to do well in the face of interest rate cuts into year end?
Well, it was what I was highlighting. You know, you're mentioning the Russell 2000 performance. There's a shift here. You know, again, to Dana's points, you got to be careful. You talk about it a lot. The first reaction isn't the only reaction, but you're introducing into the debate a higher probability of policy mistake, into the debate that this is no longer about maintenance cuts, that it is more risk of the hard landing, as opposed to the soft landing narrative and calibration cuts that, you know, you can cut interest rates and that's a good story for risk. You're adding a bit more probability mass on the downside scenarios. Again, you know, it's one data print. It's relatively still strong, but the pace of change, I think, as we've highlighted earlier in this call, the pace of change is a little bit worrisome.
Jeff, so are you on the side that this is deterioration, not normalization?
Well, the kind of knee-jerk reaction this morning is clearly that this is deterioration, again, because the pace of change is kind of accelerating. And when you take kind of the totality of the week's data, it's all kind of piling into that side. Now, it's obviously affected by some other things. You've got the tech earnings side. You've got the Middle East uncertainty. So we have to be careful about kind of lumping all of the market moves into the economics. But clearly on the morning reaction, this is a reaction to an acceleration to the downside relative to that more expected consensus view around, you know, more gradual. So it is a bit worrisome in that regard.
Jeff, awesome to catch up, buddy. As always, Jeff Rosenberg there of BlackRock. Just got a note straight from Andrew Honhorst of Citi. Here's one for you. 50 basis points is absolutely on the table after the rise in the unemployment rate, with the SARM rule all but triggered and financial conditions tightening as equities sell off. The Fed may need to over-deliver on even the more dovish pricing now in the market. High inflation meant the Fed waited to cut rates, and now they may need to cut more sharply. That last line again. The Fed waited to cut rates because of high inflation, and now they may need to cut more sharply. We've had a conversation in the last 15 minutes. We've had one guest who's been constructive on the economic data in front of us, and they've talked about the levels. And then we've spoken to a market participant who's talking about the change plus the pace of that change. And Mohammed, it's the latter that's driving this market in quite a material way this morning.
It is, and I think rightly so, because we are seeing a rapid deterioration in the economy. John, I'm really glad you brought up inflation, because we have stopped talking about inflation. The assumption is that the inflation is conquered, and conquered per the Fed's 2% target. I'm not sure that's quite correct. I think inflation is conquered if you're willing to live with 2.5% to 3%. But if you're willing to live with 2%, we're not there yet. And that is going to complicate the Fed's policy reaction function even more.
Jackson Hole is going to be fascinating, isn't it? The speech that this chairman's got to deliver after a payrolls report like that.
If he's willing to address the major monetary policy issues, he may not want to do so.
Getting a lot of Fed speak through the next week or so, including a sit-down interview with Mr. Goolsbee of Chicago. President Goolsbee and Michael McKee. Mike McKee, I imagine that interview's changed after that data from 20 minutes ago.
Well, yeah, the first question might be a little different than in the past. I might let Mohammed come along and ask you. I'll hold up your column from the other day.
He's been on the right side of this conversation out of everyone on the committee.
He has. The interesting thing, though, is what comes next in a month where there's maybe going to be speeches, although nobody at the Fed has speeches scheduled for next week. And we got to wait till the end of the month to hear from Chairman Powell. There's no meeting in the month of August. We have to go till September 18th. So if these numbers keep coming in poorly, then, you know, what does the Fed do about that?
You don't think we get any speakers between now and the end of next week?
Oh, well, I'm just saying we have the schedule for the Board of Governors, and they're on vacation. So, you know, I hope they have a good time.
Mike, out of all the data points now, between now and Jackson Hole, I'm thinking of ISM services, a few more jobless claims read, CPI print in the mix as well. When you look at the totality of the data, when you see notes like this from Andrew Honhorst and Citi, not a base case, but saying 50s on the table for September, you've been through a few of these growth scares in the past. I don't know where we're going to be by the time we get to September, but do you think 50s on the table? for September?
I still
now?
don't think so, because I think that that would be read as panic. Now, obviously, they'll have another jobs report. If we get another 100,000 jobs and unemployment continues going up, that could change everything. But as of today, they're going to say, well, we have a lot of data in front of us. Let's see what that says. Markets have to price minute by minute. The Fed doesn't. So I think you're going to see some volatility in this, and they'll push back on that.
What do you think they do with the 4.0% unemployment rate by the end of 2024?
Well, that's something they're probably going to have to adjust. 4.1% is what they thought they would have, and we have just blown through that. We have to see if it comes back. Interestingly, got a note from Omar Sharif, who takes this stuff apart in minute levels, and he notes that most of the rise in unemployment was people who are on temporary layoff. Permanent job losers only went up by 40,000, and he thinks that we might see a reversal next month in the unemployment rate, in which case the Fed comes out and says, well, so we were right.
Mike, do you think the White House and Democratic leaders are going to turn on Jay Powell?
No, they won't turn on Jay Powell. They recognize that it's kind of out of their control, and we're talking about a very blunt instrument. You can't fine-tune the economy that well, but if we continue to see this and we don't get a rate cut, then they might. But you've already heard the governor of Illinois say Fed rate policy is slowing down companies. They can't.
We're going to hear more of that for sure in the next few weeks. Mohammed, just in the final 60 seconds, final word. What a morning, what a week, what a start to August.
Yeah, I thought what a week before today, and now are we just 2 days into August?
I know, seriously, it's August 2nd. Amazing. I thought July was exhausting, and August is absolutely exhausting. I want to run you through next week at the trading diary, because this is what it looks like. There's some important data on Monday when we get S&P Global PMIs, ISM Services, and the Senior Loan Officer Opinion Survey. Lots of Fed speak as well picking up through the week too. On Tuesday, we've got a US trade balance. On Wednesday, get more corporate results. On Thursday, another round of jobless claims. And Thursday and jobless claims is like the big data point alongside ISM Services for the week ahead. On Monday, what a lineup. Claudia Sahm of New Century Advisors, Sarah Hunt of Alpine Saxon Woods, Lindsay Rosner of Goldman Sachs, Andrew Hollenhorst of Citi. Sahm on the Sahm rule, Hollenhorst on the potential for a 50 basis point cut in September. Hello, August, I guess, from New York. This was Bloomberg Surveillance.